Hello friends, hello students, how are you? Hope so, you're doing good. So today it's our last lecture of NR Taxation, chapter 21 of your ICAI module book. Uh, Before we start, just a simple thought to share with you. See, we receive a lot of message from students that my friends' preparation is at much advanced stage. I have not done yet. A lot of time has been wasted. Now a very less time is remaining. How will I be able to complete the course and all this? See, one or two things on this. One, you just need not to compare anything with anybody. You are unique in yourself. Your capabilities are unique. And you don't know whether the one you are comparing with, it's only doing it at surface level, is not going deep. He may face problem at the time of revision. You might be doing in depth at the time of first preparation only. So you will take less time doing the revision. You know. Secondly, whenever you feel that time is less, you put more efforts. The see the word rewards the presentation, but the God rewards the intention. Okay. If your intention are pure, you are actually working hard, you are honest to the ICI, honest to your studies, honest to yourself, honest to your parents, then the result will be in your favor. You know, don't no anxiety, no fear, because this will only and only waste your time. They will not help you in any manner. Time is sufficient to clear the exam, even if you have not even started with. So always remember, discipline is more important than the motivation. Prepare a routine, prepare a schedule, and have a discipline to follow it consistently. Consistency, there's no other magic than the consistency. Consistency can bring a magical results. Whatever small efforts you do, if you do it consistently, now the results are really, really magical. Do believe in God. And lastly, the hard work always the hard work beat talent when talent doesn't work hard. So this is a very, very good quote. It says, what it says, hard work beats talent if talent doesn't work hard. So doesn't work hard. So if there is a fight between will and versus skill, who will win? My dear friend, if there's a fight between will and skill, who will win? I'll tell you, it's always the will who wins. So you must have a will to succeed, then everything will fall into place. Okay. With these thoughts, let's start our last class of annual taxation. But as I told you in the last class as well, we whatever we do at the same time doing the revision is equally important as the understanding of the subject. If you have invested a lot of time in understanding the subject, but if you don't do the revision, then the next time you start the topic, it will be something like a fresh. So the whole time you have invested in understanding, in-depth understanding, gets wasted. So revision is very important. So today being our last class, what we'll do, we'll at the end, we'll do the revision of the entire chapter. Okay. But now let's first start with the our remaining topic in NR taxation. So normally we are left with the miscellaneous topics, but they are actually important and they are generally being asked in the exams as well. Okay. So first topic is deduction of head office expenditure in case of non-resident. Section 44C. See, I'll tell you the rationale. What happened is that, first tell me why I'm talking about the reduction of expenditure of HO expenditure in case of non-resident. So is non-resident liable to tax in India? Yes, he is liable to tax. And one of the reasons for which he is liable to tax is the if he's doing business, tell me in India or with India. We discussed this. If he's doing business, yes, in India. In India means he's doing business within the India. Okay. Yes, in India. So if you have a business connection, if you're doing a business in India, then you have a business connection, and therefore now your income is taxable. So once you have a business connection or PE, similar concept, business connection is domestic tax concept, and PE is a DTAA concept. If you have a business connection or PE, then you compute your taxable income in India and pay tax. Okay. Business connection generally signifies presence of a non-resident in India. Very simple way of having a business connection or PE is having a branch in India. If you have a branch in India, if you're doing a business in India, you have a physical presence in India, then the income which this branch is earning from India is liable to tax in India. Okay. The question comes how you compute this income. If you remember, we did some presumptive tax sections, which provides a presumptive rate of computing the income. But they were very much specific to the nature of business which the NR is doing. Shipping, aircraft, turnkey power project, mineral oil, and cruise ship, and lastly, the electronic manufacturing facility. But if the branch of a non-resident or a foreign company is doing some other business, then such branch need to compute its taxable income in India and has to pay tax in India. For computing taxable income in India, the provisions of PGBP Head Chapter 4D is applicable. So the branch prepare its profit and loss account, sales, and expenses. Then the net profit is derived, and this net profit is adjusted to as per the provisions of the PGBP, and then the taxable income is arrived at. Okay. But when you are allowing the computing a net profit, there's section 37 under that PGB. What it says? It says any expenditure incurred wholly and exclusively for the earnings income shall be allowed as deduction. If expenditure is incurred for earning this income, shall be allowed as deduction. Section 37 nowhere says that such expenditure has to be incurred in India. You with me? It only says that the expenditure should be incurred wholly and exclusively for the earning such income. If so, the concept is if the only the net income is taxable, not the revenue. So whatever expenses are incurred by the assessee for earning such income are allowed as deduction. Okay. In case of foreign companies having branches in India, they may say that there are a lot of expenses which are actually being incurred by foreign company for the purpose of Indian branch. And most of these expenses are in the nature of apportionment. To understand the meaning of apportionment, meaning thereby, it's not that the expense was incurred wholly for this Indian branch, but a part of the expense is also benefiting the Indian branch. So, if the accounts of the foreign companies are maintained outside India, then the accounts of this branch is also maintained outside India. And the expense which the foreign company is incurring in respect of its accounting, a part of it is also attributable to the Indian branch. There are people who are getting salary from the foreign company outside India, and a part of their time is also invested in respect of business of Indian branch. They are people who are traveling for the purpose of Indian branch, and the travel expenses are being booked in the accounts of the foreign company, HO. So, so the question is, so the point is, there are a lot of expenses which are being incurred at HO level, which are pertaining to the Indian branch. And as per Indian law, such expenses, if they are pertaining to the Indian branch, should be allowed as deduction in computing the taxable income of Indian branch. Any doubt? You are with me? We have any doubt? Do let me know. We are doing it very slowly, logic wise. So, firstly, if the non-resident has an Indian branch, then it would constitute as a business connection in India, and therefore the income of Indian branch is taxable in India, and therefore the Indian branch is required to compute its taxable income. For computing taxable income, Indian branch is allowed a deduction of all such expenses which are incurred wholly and exclusively for the purpose of earning such income. But in addition to the expense incurred in India, which are specifically for the Indian branch, there are a lot of expenses are being incurred at HO level outside India, which is for the benefit of, or a part of such expense is also benefiting the Indian branch. So such part should also be allowed as deduction in computing the income of Indian branch, and only on the net income the Indian branch is liable to pay tax. This much very much clear. Okay. So what's the problem? Okay, we can do that. But here comes the problem. It is difficult for the Indian tax department to actually verify this HO expenses. The expenses incurred outside India, and they are, which the Indian branch claims that they have been incurred for the benefit of Indian branch, but they are incurred by HO outside India. Indian branch has reimbursed such amount to the HO. So the question comes, it's very difficult for the Indian tax department to actually scrutinize such expense and to conclude and to come to the conclusion that they have actually been incurred. They are not bogus. One. Secondly, they are for the purpose of Indian branch. So there is an inherent difficulty in scrutinizing the expenses incurred outside India. You guys understand? Okay. So for this, now what the government has option? Government has two or three options. One option is they disallow. Even if you have incurred an expense outside India, no matter, let it be, I will not allow you deduction in computing your Indian taxable income. But if they say so, it would be quite a harsh. It would be a harsh for Indian branch, because, and also not very much logical, not goes with the scheme of the act, which says that all expenses incurred for earning an income should be allowed the deduction. Okay. So this is an extreme step. So government has not taken an extreme step. Another option was, let it be. Whatever the law is if you can check very well. If you can't check, you have to allow the expenses. Then it is another extreme situation which is against the government and the income tax department. What the government has brought out a midway. They said that we'll fix a limit. What we feel that is reasonable, we'll fix a limit, and expenditure up to such limit only shall be allowed. Any expenditure in addition to that limit shall not be allowed. No question asked, even if you can prove that they are incurred and they are for the purpose of Indian branch, still I will not allow. Once there is a limit, there is a limit. So the government has set a limit of 5%. We'll discuss 5% of what and what all in detail. So there is a limit. There is a limit up to which the actual expense can be claimed as deduction in computing the total income of Indian branch. So you are with me? You understood why we are discussing the deduction of HO expenses? Because These are allowed to be deducted while computing a total income of Indian branch. Why? Because the income of Indian branch is taxable in India. Why? Because the Indian branch is actually doing business in India, and therefore the foreign company, the main foreign company, is said to have a business connection or permanent establishment (PE) in India in the form of this Indian branch. Okay. Now let's see the provisions. It says, notwithstanding anything contained in section 28 to 43A. First of all, the deduction of HO expenses is given in section 44C. Section 44C is a PGBP section. It comes under that PGBP. So it has to be under PGBP only because we are discussing, we are actually computing the PGBP income of the Indian branch. Yeah, because the Indian branch is liable to tax because it constitutes a business connection, and therefore income has to be computed under that PGBP only. Now the section start with non-obstante clause. It says, notwithstanding anything to the contrary contained in section 28 to 43. At first, it overrules the entire PGBP. It says, why it overrules? Can you tell me? I tell you. It overrules because now somebody cannot argue that section 37 allows all the expenses which are incurred for the purpose of earning the income. Therefore, why are you limiting? So now, no such argument, because if there is a conflict between section 37 and 44C, the 44C shall prevail because section 44C overrules section 37. It overrules all other sections. Okay. A non-resident shall be allowed deduction of head office expenses incurred outside India, being lower of the four. So the expenses are limited to either 5% of the adjusted total income or amount of HO expenses, actual expenses incurred attributable to business or profession of assessee in India. So 5% of adjusted total income or expenses, actual expenses, whichever is less, shall be allowed as deduction as HO expenses. So if the actual HO expenses claimed by assessee exceed 5% of adjusted total income, the excess shall not be allowed, irrespective of the fact that assessee can prove that such expenses were incurred wholly and exclusively. Why irrespective? Because my section 44C overrules the entire PGP Act. So even if your expense satisfies the condition of PGBP head of the section of PGBP head, still the maximum deduction which can be allowed to an branch of a foreign company in respect of HO expenses is 5% of the adjusted total income. Such expense cannot exceed 5% of the total income. Understood the rationale of section 44C? Now, what is adjusted total income? Adjusted total income means total income without giving effect to HO expenses referred to in the section. Of course, if we are computing the HO expenses to be allowed, then the adjusted total income means the income. To compute adjusted total income, we have to ignore this HO expenses. It says incurred outside India. Yes, Mr. Sanjay, it says. So HO expense means the expense which are incurred outside India. This is what we started with. Because if the expenses are incurred outside India, then it's a problem for the income tax department to how to scrutinize it, how to verify it, how to verify the genuineness, actual incurrence, and yeah. So the question is, the section is applicable in respect to expenses incurred outside India, but it is for the Indian branch, isn't it? Yes. Though expenses are incurred for outside India, they are actually being incurred outside India, but they are for the Indian branch. Or you may say a part of it is for the Indian branch. So apportionment, a part of, say there is an employee who is working outside India, but a part of 20% of which time is invested in Indian branch. So the Indian branch is eligible to claim the deduction of 20% of his salary. So these type of expenses we are talking about. Hmm. So there's inherent issue in scrutinizing this type of expenses. Whether this 20% is should be 10% or 30% is very difficult. So therefore, Section 44C came, wherein the government puts a cap of 5% of adjusted total income. Okay. Now, what is the adjusted total income? Means the total income. So you will compute the total income, but you will not consider the following items, which are first HO expenses, very much logical. You are computing the HO expenses only. Then the brought forward things. We are not concerned about the earlier years. So unabsorbed depreciation and brought forward losses. Okay. This shall not be considered by computing the adjusted total income. So we are looking for total income of the current year. Then capital expenditure on family planning. If any deduction is claimed in respect of capital expenditure on family planning, then such deduction shall be added back. And now, lastly, the deduction chapter 6A. You will add all these four items and you will compute your adjusted total income. And your actual expenses shall be limited to 5% of this adjusted total income. Are you with me? Any doubt? Okay. Now, the question comes, if there is a loss in the current year, if this ATI, adjusted total income, comes out to be negative, then what will happen? Then 5% of negative will be negative, meaning thereby no deduction in respect of HO expenses. But this would again be an extreme position. The loss is where the adjusted total income is a loss. 5% of average adjusted total income shall be considered. So if there is a loss in the current year, adjusted total income comes out to be a loss in the current year, then I have to take the average of the last 3 years. If there's a loss in the current year, then I'll take the average of the last 3 years. Average adjusted total income is the average of adjusted total income of immediately preceding 3 years. So I will take the average of the last 3 years and I will compute 5% of such average amount. However, if the income of the assessee is assessable in India for less than 3 years, if the Indian branch was there in India for less than 3 years, then I consider the period for which the Indian branch was there. If the Indian branch is for more than 3 years, I'll consider the last 3 years. If Indian branch is only for 2 years, I'll consider the average for the last 2 years. If Indian branch was only for a year, I'll consider only for that year. Okay. If the income of the assessee is assessable in India for less than 3 years, then the average shall be taken for the years the income was assessable in India. Okay. So I am talking about financial year 25-26. So if there is a loss in financial year 25-26, then I have to take the average of the last 3 years, meaning thereby financial years 24-25, 23-24, and 22-23. I have to compute the average, the adjusted total income for all these 3 years by applying the above formula, by adding the unabsorbed depreciation, brought forward losses, family planning expenditure, capital expenditure of family planning, and lastly, chapter 6 deduction. And I'll do the average. Average means I'll say this amount is 10, this is 20, this is 30. Then average it, aggregate this amount and divide it by the number. So the average is 20. Okay. I'll do the average and I will apply 5% on this average. See, if there is a loss, then the adjusted total income is computed for the preceding 3 years. In such case, the relevant year for which I am computing the actual expense is not even relevant. The total income for current year is not relevant. The question is, if there is a loss and it is the only year, that is first year, then there will be no allowance. Is that right? Yes, sir. So the question is, If the branch is started only in the current year, there is no earlier years when the branch was there in India. So, and in the current year, there is a loss. So I cannot go back because the branch was not present at that time, and therefore now there is a loss. So the branch shall not be allowed to be claim any deduction in respect of HO expense in this year. Okay. So yeah, I was telling you, if there is a loss in the current year and the branch is there since long, so I have to consider last 3 years. Then for computing the average, I will not even consider the current year. Okay. What do you mean by HO expense? HO expenditure means executive and general administrative expenditure incurred by SSC outside India. Who is SSC? SSC is a foreign company. SSC is not the Indian branch. The branch is never an SSC. Branch is only an extension of the company. Branch doesn't have a PAN number, separate PAN number. The PAN number is of the company. A company may have multiple branches. It doesn't mean that it will file multiple income tax return. All these branches shall have single PAN. Okay. If you know, of course you know, the banks have multiple branches. You know, SBI may have 20,000 branches, but it doesn't have 20,000 PAN. It doesn't file 20,000 income tax returns. So all these branches all have a single PAN, SBI. The branch is only an extension of the company. And the transactions, the P&L, the balance sheet of all these branches are consolidated into the P&L and balance sheet of the SBI, HO, and from such balance sheet, from such financial statement, the income tax return is filed. Okay. So HO expense means the expenditure, means the executive and general administrative expenditure incurred by SSC outside India. That was the problem area, including expenditure incurred in respect of rent, rates, taxes, repairs, or insurance of any premises outside India used for the purpose of business or profession. So the company is paying, the foreign company is paying rent outside India, in which its employees are sitting, and a part of time of such employees is also invested in Indian branch, in managing the Indian branch. So a part of rent is also attributable to the Indian branch. Now you're actually feeling how difficult it is for the Indian income tax department to to allow the deduction. Yeah, they will never have a confidence that when whatever the SSC is claiming is actually right or not. Other types of example, these are all example given in the act. Salary, wages, annuity, pension, fee, bonus, commission, gratuity, perquisite, profit in lieu of, or in addition to salary, whether paid or allowed to any employee or other person employed in or managing the affairs of any office outside India. So I have employed people outside India, and they're also managing the affairs of Indian branch. So a part of their salaries, perquisites, and what do you say, their retirement benefits is all attributable to the Indian branch. Traveling by any employee or other persons employed in or managing the affairs of any office outside India. So the traveling expenses of these employee or any other person, all these expenses actually incurred outside India and are recorded in the books of accounts of the foreign company outside India. Yeah. Such other matters connected with executive and general administration as may be prescribed. Okay. Income of Indian branches of foreign companies computed normally under Section 28 to 44D. That KGBP. Section 44C provides that such branches shall be allowed deduction of HO expenses incurred outside India to the extent of 5% of adjusted total income. Now you know the reason why. Why Section 44C actually limits. Okay. Now we will do some questions for HO expenses. Question 1. The net result of business carried on by a branch of foreign company in India for the year ended 31st March 2026 was a loss of rupees 100 lakhs after charge of HO expenses, head office expenses of rupees 200 lakhs allocated to the branch. So the question says the fact is there is a branch, Indian branch of a foreign company, and such branch has actually incurred a loss of 100 lakh, but this loss is computed after allowing the deduction of HO expenses amounting to 200 lakh. So before this expenses, there would be a profit of 100. Then we claim 200 lakh as an expense towards head office expenditure, and therefore we computed 100 lakh as a loss of the Indian branch. Okay. Explain with reason the income to be declared by the branch in its return for assessment 26-27. The question is, what is the income which the branch is required to declare in Indian income tax return? So what are the big question? There is a loss of 100 lakh, so branch will declare 100 lakh loss only in the return of income. Right or wrong? I need not to apply my mind here. Right? Wrong, sir, wrong. We discuss while computing this 100 lakh loss, the branch has taken a deduction of 200 lakh of rupees towards HO expense. But whenever there is a word HO, a bell rings in our mind, and we are reminded of section 44C, which says the HO expense cannot exceed 5% of the adjusted total income. Good, Sanjay ji. So I have to compute the adjusted total income. For computing the adjusted total income, I have to add 5 things. First, the HO expense already deducted. Then unabsorbed depreciation, brought forward losses, deduction of chapter 6A, and lastly, capital expenditure on family planning. So last 4 things is not there, but there is a HO expense. So there is a loss of 100, but I'll add 200, and 100 is the adjusted total income, positive 100. Yeah, so there is a 100 lakh of income, adjusted total income. 5% of this comes to 5 lakh. So my deduction towards HO expense can be lower of 5 lakh or actual 200, whichever is lower. So lower is 5 lakh. So my deduction cannot exceed 5 lakh. So here the assessee is claiming 200 lakh, but I replace it with 5 lakh. So the answer would be the income which I will offer in my Indian income tax return is 95 lakh. You with me? So section 44C restricts the allowability of HO expenses to the extent of lower of an amount equal to 5% of the adjusted total income or amount actually incurred as is attributable to the business of the assessee in India. For the purpose of computing the adjusted total income, the HO expense of 200 lakhs charged to P&L have to be added back. You're with me? So the amount of income to be declared by the assessee will be as under. Net loss 100 lakhs, amount to be added back towards HO expense 200 lakh. This 100 lakh becomes the adjusted total income. Now I will reduce the HO expense, which shall be 5% of this 100 lakh, means 5 lakh, or the actual expense 200 lakh, whichever is less. So I allow 5 lakh, and this is the income 95 lakh, which shall be I offer to tax for my India taxation. Okay. See, where the students lose marks. Student does everything. He writes 5 lakh, but he doesn't compare this 5 lakh with the 200 lakh. If I tell you, he even compares it, but he compares in his mind. He doesn't write it. So now think of an examiner. Examiner cannot read your mind. Examiner only see whatever is there in your answer sheet. Examiner text you on what you write on your answer sheet. So remember 2 or 3 things. One, think by writing. Try to write whatever you are thinking, so that you may get marks. There's a stepwise marking ICAI paper. So there might be a mark which you may not get because you know the answer, you know that step as well, but you didn't write it. Therefore, you may lose that step mark, half or 1 mark. And mind you, trust me, this half and 1 marks makes a lot of differences. The entire paper is divided into half and 1 mark, and these half and 1 marks makes a lot of difference. Mm. Secondly, secondly, Sanjay ji, I'll just come to you. First, try get into a habit of writing. And see, what happens is that when the student writes 5 lakh, claim the deduction of 5 lakh, then it's very much obvious that he actually knows that the 5 lakh or 200 lakh, whichever is less, is the allowed. But examiner cannot give you marks unless you write it. Yeah, he understands, he feels the pain. He feels that you know, but you have not written. And since you are not written, he is bound to cut the marks. You understand that? Right. Secondly, you don't worry about the space. Yeah. Write as much, of course, within the time availability, write as much is required. Don't worry about the space. See, what happened is that uh, a student wants to write 2 or 3 lines, but there's only a one line, single line is left on the page of the exam. So what he does, he cuts short his 2 or 3 lines into that one line only, and he very densely writes everything in that one line only, and he cut short the content as well. Yeah. So don't do that. Use your another sheet. ICAI says that uh, each question has to be on the new sheet. So let the sheet be filled only 2 lines, and let the the remaining sheet be blank. But don't do this silly things. You understand things? Yeah. Okay. Because this half 1 marks actually adds up to your 60, your rank or your exemptions. So Sanjay sir is saying, I also did it, think it wrong way, think it wrong way. Yeah, so he's saying, I think he's saying that he also did this in his mind. Okay, so get into a habit of writing. Yeah, and lastly, yes, you have to. There is no option. This it is not negotiable. You have to attempt 100 marks of paper. See, even if there's a question in your text paper which is related to the chemistry, which is related to the physics, you still have to attempt that question. You're getting what I'm trying to say? I'm trying to say, even if a question comes which is out of syllabus, or which from a chapter which you have not studied, or out of the word, whatever, no worries. You must attempt 100 marks. So you must get a marks out of 100, not out of 90, because 10 marks you not even attempted. Okay. So if you have not studied the topic, you don't have any idea about the question, then be a finance minister. Attempt as if what would be the logical, as if you were a finance minister. What would be you make that law? You know? But you have to attempt. Don't leave paper. I'm telling you, my friends, this half mark, 1 mark, because if you attempt, most probably the answer will be wrong, but there may be some steps which you clicked right, and you will get half or 1 or 2 marks out of 4 or 6 marks question. Then this half or 1 or 2 marks will actually makes a difference. You know, believe me. And this I am talking about all the papers. Second, question number 2. The net result of business carried on to a branch of a US based foreign company in India for the year ended 31st March 2026. So there is a US based foreign company, It has a branch in India. And the net result means the net profit or loss of such branch for the year ended 31st March 26 is 28 lakh after charging the following expenses. So there are around 7 expenses which have been given, and after adjusting all these 7 expenses, the branch computed a loss of 28 lakh. We'll discuss. Let's see what the question is. The assessable adjusted total income of the assessee for the 3 immediately preceding assessment years was this, and this. So the question gives the adjusted total income for the 3 earlier years. AY 25, 26, 24, 25, 23, 24. Okay. You are required to compute the income to be declared by branch in its return for the assessment year 26, 27. This was an exam question, recent exam question number 24, 6 marks. See, simple topic, just 2-line provisions that actual expenses shall be allowed up to 5% of the adjusted total income or actual expenses, whichever is lower. Adjusted total income means the total income without considering actual expense, unabsorbed depreciation, brought forward losses, capital expenditure on family planning, and Chapter 6 deduction. If there is a loss, if the adjusted total income comes out to be negative, then you have to compute the average adjusted total income for the last 3 years. Only this, 10 seconds of provisions, and the entire question for 6 marks. See, you're getting it? So, can you do it? Can you do it for me? So, firstly, can you compute the adjusted total income? Okay. So, you want to try? I give you 3 to 4 minutes and you tell me what is the adjusted total income. There is a loss of 28 lakh. Then the first point says depreciation for the current financial year is 35 lakh. There is unabsorbed depreciation of 18 lakh. Short-term capital loss of 1.5 lakh on sale of shares of Indian company received in US. But since the shares are sold of Indian company, the gain or loss is subject to Indian taxation. The receipt is not important because the accrue arise in India. Expenditure income for payment in respect of voluntary retirement scheme, rupees 12 lakh. Speculative business loss brought forward, AY 24-25, 17 lakh. Deduction the chapter 6 said 29 lakh. And HO expense 165 lakh allocated to branch. So, what the branch has did, they have computed 28 lakh after considering these expenses. Now, the question asks the income of the branch. To compute the income of the branch, I need to compute my HO expense, which is allowed as deduction. To compute the actual expense, I have the actual HO expenses, which is 165 lakh. I need adjusted total income because 5% of such adjusted total income shall be the maximum cap up to which the HO expense shall be allowed. So, the question I ask, what is the adjusted total income? Okay. I know you are doing and it takes time, no worries. Yeah. Since it's a recorded lecture, the others may get bored. So, I'll also do with you. So, there's a loss of 28 lakh. This loss has been computed after considering all these 7 items. I have to see which of these items are not allowed in computing the adjusted total income. Depreciation current financial year 35 lakh. Is it allowed or not? It is allowed. Unabsorbed depreciation is not allowed. So no adjustment towards this. Unabsorbed depreciation, yes, I have to add it back. So let's see. I add it back. Short-term capital loss of 1.5 lakh. Now see, there is no provision which says that short-term capital loss should be added back while computing adjusted total income. But if you observe, if you have a focus, you will see that the adjusted total income starts with the word means the total income. So first You have to compute total income, then you make these additions. Okay. So this short-term capital loss can be adjusted only against short-term capital gain or long-term capital gain. No, only against short-term capital gain. So it cannot be adjusted against the PGBP income. And therefore, this adjustment of short-term capital loss is not right. Not because of section 44C, but because of computation of total income. So I'll add it. Expenditure incurred for payment in respect of voluntary retirement scheme rupees 12 lakh. Right? So again, this rupees 12 lakh, the voluntary retirement scheme is allowed in 5 installments. So they have added back, they have reduced 12 lakh, but only 1/5 of it, 2.4 lakh, shall be allowed, and the remaining 9.6 lakh has to be added back. Then speculative business loss of earlier year can be set off only against the speculative income. So they have wrongly adjusted it. It is again to be added back. The deduction under chapter 6 of 29 lakh, it's not allowed while computing the adjusted total income. It should be added back. And the actual expenses which is debited shall be, of course, be added back. So if I see, you have the loss 28 lakh, 20 depreciation, no adjustment, as we told you. Another depreciation you have to add because specifically stated in section 44C. So I did this because of 44C. Short-term capital gain, I did this because of total income adjustment. Expenditure on voluntary retirement scheme, whereas total income adjustment. Brought forward speculative business loss, total income adjustment. Had it been a brought forward business loss, then also it would be added. But then it would be added because of section 44C. You're getting the point? Reduction chapter 6A, 44C. Actual expenses, 44C. So there's a loss of 28 lakh. I added all these items and I come to 2 lakh 12,000, 2 crore 12 lakh 10,000 as my adjusted total income. And my expenses, my actual expense shall be up to maximum of 5% of this amount, which is 10 lakh 60,500. If you see, actual expense shall be allowed, which shall be lower of 5% of this amount, 10 lakh 60,500, or the actual expenses 1 crore 65 lakh, whichever is lower. So the lower is 10 lakh 60,500. The question doesn't end here. It's only the notes. It's on the working note. Because question asks the income which the branch is required to declare in the income tax return. Okay. For computing the income, I need the actual expenses which shall be allowed. So I only did a one part. I have computed the actual expense which shall be allowed in computing the income. So though the branch has actually claimed 1 crore 65 lakh, only 10 lakh 60,500 shall be allowed as a deduction towards actual expenses instead of 1 crore 65 lakh. So now I compute the income. It says 28 lakhs the loss. Now I will make all those adjustments which are not allowed in the income tax law. The short-term capital loss not allowed. Why? Because this can be adjusted only against the capital gain head, not under the head PGBP. Expenditure on VRS is allowed in 5 installments in equal years. So I'll add the 4/5. Brought for speculative loss is not allowed because it's allowed only against the speculative income. Actual expense shall be allowed only up to 10 lakh 60,500. So I will add whatever is actually reduced and I will reduce what is allowed. Okay. And this comes the income of the branch. This actually return of a foreign company. So this income shall be taxable at the rate applicable to the foreign company. Okay. Because branch is nothing but an extension of a foreign company, of its principal. So you understood this question? 6 marks question. Simple question. If you know a subject, if you know the provision and a very small provision, and you actually is attentive. So though these are question of section 44C, but actually test VRS provision, the set of provision. So generally these type of questions only asked where not a single provision would be tested, but along with single provision, there will be small basic provisions which we all know by heart. Okay. So next question. The net result of the business carried on by a branch of a foreign company in India for the financial year 31st March 26 was a profit. Thank God. For the first time, the branch made a profit, not a loss. Okay. If you come to the last question we did, if you remember, there is a adjusted total income for the last 3 years given in the question. We have not used it. Why? Because when we actually compute the adjusted total income, it was not a loss, it was actually profit. It was in positive figure. And once it's a profit, I need not to go to the earlier years. I compute the average of the earlier years only if this figure had come to be a loss. Had this figure was a loss, I would have computed the average. And the average, for the average, I will use this. I would have used this data. So average is 6 plus 5 plus 450 divided by 3. Okay, whatever it comes. But since for the current financial year, for the relevant previous year, the adjusted total income comes positive, I have not used this data. So they have given this data to confuse you because they have started the question with a loss. So they don't want you to actually compute the adjusted total income and just apply the average and compute the actual expense. In such case, there would be a lot of mistakes, lot of wrong things, you know, in the question. So now in this question or the next question, the branch has actually earned a profit of 20 lakh. Good. But after charge of the following items, depreciation of current financial year, good. It has been charged, it should be charged. Another depreciation. So while computing the adjusted total income ATI, I will add this 17 lakh because it's unabsorbed. Capital expenditure income for promoting family planning amongst its employees for of rupees 7 lakh. 7 lakhs, 1/5 of total expenditure incurred on promoting family planning. So they have claimed a reduction of 7 lakh as a 1/5 of capital expenditure for family planning. But this shall be added by while computing the adjusted total income. Expenditure income scientific research, no problem. Business loss brought forward. It's also added by only for adjusted total income. So if you see here, the company has perfectly computed the total income as per the tax laws. In the earlier question, they had made mistake. They had claimed short-term capital loss, speculative loss against the normal PGBP income, which is not allowed. But here, they have claimed another depreciation, perfectly allowed. They have claimed only 1/5 of the family planning expenditure, perfectly allowed. They have claimed the business loss brought forward, perfectly allowed, as for complete total income. Though they have to be added by for complete adjusted total income. Deduction 20 lakh, again to be added by under section 44C. Actual expenses of 125 lakh allocated to branch to be added by. So I have to add back these 1, 2, 3, 4, 5 items to get my adjusted total income. So 20 plus 17 plus 7 plus 25 plus 20 plus 125. So my adjusted total income come out to be, yes, 214. 2 crore 14 lakh. That 5% of this is 10 lakh 70,000 or the actual expense, which is 125 lakh. Lower of these two shall be allowed as reduction under section 44C, which is 10 lakh 70,000. Now the question asks me to compute the income, the Indian branch, that Indian taxable income. So if you see, all the adjustment which the company has done is as per the tax law. So just one adjustment I have to do. The company has claimed a deduction of 125 lakh. Instead of this, I'll allow 10 lakh 70,000. So there's a profit of 20 lakh. I add 125 lakh and less 10 lakh 70,000. So this will give me the income 1 crore 34 lakh 30,000. Yes. This will be the income taxable in India in the hands of Indian branch. Any doubt? So very small and interesting provision, HO expenditure. Okay. See, this happens. If you see a two-line provision to half-page provision, we invested around an hour in understanding during the practical portion and actually actually going into depth into this provision. You know? But if you don't revise it, now you will forget all this discussion. This is not a problem with you, it's a problem with everybody. You know? And it's not even required to actually remember all this discussion. This discussion gives you a strength or a confidence that these are not a difficult problem. What the in your exam, the examiner doesn't ask why this provision was introduced. What he normally asks, what he asks is that what the provision says and its application in your real world situation, the facts given in the question. Okay. We discuss why it's introduced because it gives you conceptual clarity. Now, next small provision is conversion of Indian branch of a foreign bank into a subsidiary company. What happened in this case is that there is a foreign bank which has an Indian branch. And this foreign bank also have a subsidiary company in India, Indian subsidiary. Can anybody tell me the difference between the Indian branch and Indian subsidiary from taxation point of view? What's the difference between an Indian branch and an Indian subsidiary? We indirectly have even covered this. Yes, Sanjay ji. Indian subsidiary is a separate legal entity. It has a separate PAN and it files separate income tax return. It's actually a company resident in India. Why? Not because its poem is in India, because it's an Indian company. It's actually incorporated under the Indian Companies Act 1956 or 2013 as the case may be. This Indian branch is actually representing the foreign company in India. It's actually a foreign company. The provision applicable to foreign companies are applicable to Indian branch. Are you getting my point? What's the provision says? If there's an Indian branch and there is a Indian subsidiary, and what the assessee wants, assessee want to convert this branch into its subsidiary, into a separate legal entity. Then this conversion is possible, is allowed as per the RBI, Reserve Bank of India, and Income Tax Act allows the benefit also. It says this conversion shall be tax neutral. This is something similar which you have already studied in your capital gain chapter as part of section 47. In section 47 also, there are a lot of transfers which are considered as tax neutral. Tax neutral means they are the gain which the seller derives, the notional gain. Because why I say notional gains? Because the Indian branch is also held by the foreign bank and that subsidiary will also be held by the foreign bank. There is actually no transfer between 1 or 2%. But since they are two separate legal entity as per the under the law, therefore a notional gain actually comes. And section 47 in other cases, what it does, it exempts such gain in the hands of the seller. So why it's tax neutral? It's tax neutral because for the buyer also, it doesn't make any change. So if I tell you, see, there's A which amalgamates into B. The A holds an asset for rupees 100. When it amalgamates, the fair market value of this asset, say, is 1,000. Then once this asset of which was purchased for 100 goes from A to B. When its fair market value has increased to 1000, the law exempt the capital gain of this 900 rupees, which could be taxed because it's actually the A has the asset has actually appreciated in the value. And at the same time, why is tax neutral? When it exempts this 900 capital gain, for B, it gives the cost to B as rupees 100 only. It doesn't give the escalated cost to B of rupees 1000. This tax neutral. It's something, nothing has changed. I will not tax this 900, so I will not give you the benefit, give the buyer the benefit 900 also. So, similar, the conversion of Indian branch into the subsidiary is also made tax neutral. Okay, let's see how. Did this arrangement fall into amalgamation as you mentioned? No, no, no. This arrangement doesn't fall in amalgamation. I was giving you an example of amalgamation because amalgamation is one of the clause, is one of the transaction which is there in section 47. So this arrangement is very much similar to amalgamation. When we see the conditions, you will realize that all this condition was there in section 47 as well when we study the amalgamation. Yes, demerger and amalgamation. Now, this section 115 JG. Special provision relating to conversion of Indian branch of foreign bank into subsidiary company. Where Indian branch of a foreign bank is converted into a subsidiary company in accordance with the scheme framed by the RBI and notification issued by the central government. Then, a capital gain arising from such conversion shall not be chargeable to tax. So this is the benefit. So they don't charge the capital gain. In section 47, what they used to say, how they used to say, they say that this transaction is not treated as transfer. The impact is same, that capital gain, whatever may arise, is not taxable. Here they have specifically stated that capital gain from such conversion is not taxable. Secondly, the provision of this act shall apply with such exception, modification, and adaptation as may be specified in the notification issued by the central government. So it says the central government has provided that the provision of the act shall, this specific provision which is there, which is provided, which is listed there in the notification, shall apply with some modification. We'll study the modification. Then it says, in case of failure to comply with any of the conditions specified in RBI scheme or in the notification, all provision of the act shall apply without any benefit referred above. If the assessee fails to comply with the conditions specified in the notification, then this benefit means the benefit of exemption of capital gain shall not be available. Then capital gain shall be taxable. Then it says, where in a previous year any benefit as referred above has been granted. Okay, so in the year of conversion, the capital gain has been exempted because of section 115 JG. And subsequently, there is a failure to comply with any of the conditions specified in the RBI scheme or in the notification. And the subsequent years, the assessee has defaulted in some of the condition which was there in the RBI notification. Then what will happen? Such benefits shall be deemed to have been wrongly allowed. The law will deem that the assessee has been wrongly allowed the exemption of capital gain. The tax officer, the AO, shall recompute the total income of the assessee for the said previous year and make necessary amendment. So the AO is duty bound. AO is duty bound to recompute the income of the previous year in which conversion took place. Why there is a need of reconversion? Because why there's a need of recomputation? Because in the year of conversion, the AO has actually allowed the exemption of capital gain, which the assessee was not entitled to. But it was not clear at that time. It becomes clear because assessee does not satisfy the condition, subsequent condition, which he needs to satisfy in subsequent year. So he satisfies the condition of such year. So RBI notification has two types of condition. One type of condition which needs to be satisfied in the year of conversion itself. Then there's second type of condition which needs to be satisfied in the subsequent years. At the time of giving the exemption, a tax officer can only check the condition which was to be satisfied in the year of conversion. So the assessee satisfied this condition and therefore exemption was provided. Exemption was actually provided rightly, correctly, no issue. But once the assessee defaulted in the subsequent condition which should be satisfied in the subsequent years, then the law says I will assume that this exemption was given, it will be deemed that this exemption was wrongly given. And the AO shall is duty bound to recompute the income of this year, the year of conversion. Okay. And how will he recompute? He will disallow the capital gain assumption and he will tax the capital gain. And for this, the provision of section 154. What is 154? The rectification of mistake. The provision of section 154 shall apply, and the mistake can be rectified up to 4 years. So 4 years shall be reckoned from the end of the financial year in which the assessee defaulted in complying with the condition which he needs to comply in the subsequent years. So the AO shall recompute the total income of the assessee for the said previous year and make necessary amendment. And lastly, the provision section 154 shall apply. Why 154? Because law assumes that while giving the capital gain assumption, it was a mistake. So 154 shall apply to rectify that mistake. And the mistake can be rectified within 4 years. The 4 years shall be reckoned from the end of the previous year in which failure to comply with the condition takes place. So if the conversion happens, say in financial year 25-26, and while filing the return of income for 25-26, assessee claimed the capital gain assumption under section 115 JG, and it was actually allowed also by the tax officer. But say on 20th November 29, the assessee defaulted a condition of the RBI or the notification. Then the AO shall recompute the income of this financial year 25-26, and he can recompute it up to 4 years from the end of the financial year in which this default happened. The default happened 20th November 29. You end this financial year 31st March 30. So add 4 years, it comes to 31st March 34. So up to 31st March 34, AO has a time to recompute the total income of 25-26 and withdraw the capital gain assumption and compute the tax payable by the assessee. Understood? Any doubt? If they ask you, there is similar provision in respect of section 47 as well. The provision is section 47A, which also applies in respect of transaction which is there in section 47. If some of the transactions require the satisfaction of condition which is there for subsequent year. If it's subsequent year there is a default, then section 47A says that the exemption of section 47 shall be withdrawn and the income shall be recomputed. And there also provision section 154 is applicable. Now let's see the condition subject to which this exemption of section 115 JJ is applicable. What is the exemption? What is the benefit? The benefit is that capital gain is not taxable. The condition is the Indian branch amalgamates with the Indian subsidiary company in accordance with the scheme of amalgamation approved by shareholder of foreign bank and the Indian subsidiary company. Shareholder of foreign bank and shareholder of Indian subsidiary company. Shareholder Indian subsidiary company is a foreign bank itself and sanctioned by RBI. So there is actually an amalgamation. Therefore, we were comparing the amalgamation provision section 47 with this. But we doesn't say it amalgamation in the term which we use because why? Because amalgamation happens between two companies. Yeah. So branch is not a company in itself. Therefore, we strictly don't use the word amalgamation the way it is defined in the act. But the condition is the Indian branch amalgamates into the Indian subsidiary with the approval of shareholders of the foreign bank and the Indian subsidiary as well, and sanctioned by the RBI. All the assets, similar to the amalgamation, all the assets and liability of the branch immediately before conversion shall become the assets and liability of the Indian subsidiary company. Everything is transferred. All the assets and liability. There is 100% conversion. The assets and liability of the Indian branch are transferred at values appearing in the books of accounts of Indian branch immediately before its conversion. The valuation to be ignored. So the assets and liability are transferred at book values. Okay. The foreign bank or its nominee shall hold the whole of the share capital of the Indian subsidiary. So the foreign bank shall hold the Indian subsidiary in which this branch is amalgamating is a wholly owned subsidiary of the foreign bank during the period beginning from the date of conversion and ending on the last day of the previous year in which conversion took place. So the period on which the conversion starts till the conversion happens, the foreign bank holds the whole of the share capital of the Indian subsidiary. An important part. And continue to hold the share of Indian subsidiary company carrying not less than 51% voting power for a period of 5 years immediately succeeding the said period. So the foreign bank must continue to hold at least 50% of shares of the foreign company for the next 5 years, for the succeeding 5 years. So this is the condition which needs to be satisfied in the subsequent years, which we were talking about. See, we were talking about condition number 2, subsequent years. So what is the condition? The foreign company continue to hold at least 51% shares of the Indian subsidiary company. If in the third year or fourth year, like in this example, on 20th November 29, the foreign company, what it did? It transferred shareholding and its shareholding came less than 51%. And therefore, the default occurred. And therefore, the exemption, which was actually allowed correctly, rightly, as per the circumstances in the year financial 25-26, is deemed to have been allowed incorrectly because the foreign company didn't hold at least 51% share in the 5-year period. The foreign bank does not receive any consideration or benefit directly or indirectly in any form or manner other than by way of allotment of share in Indian subsidiary. Similar to, so all these conditions are very much similar to the amalgamation one. Okay. If you see there are 5 conditions, the 4 conditions are to be seen in the year of conversion and only the condition of 51% shareholding is to be seen in the subsequent years. So first is the branch amalgamates with the subsidiary company with the approval of shareholders. Then all assets and liability are transferred at book value. Then it says the subsidiary company is wholly owned subsidiary in the year of conversion. And lastly, the foreign company, the foreign bank does not receive anything other than the shares in the Indian subsidiary company. Okay. If we satisfy this condition, then section 115 JG says that the foreign bank shall not be liable to pay the capital gain on this conversion of its Indian branch into Indian subsidiary. Now, the law says I will modify some of the provisions. This is again very much similar to the amalgamation. The provision of the Act shall apply with following exception, modification, and adaptation. The depreciation for the year of amalgamation shall be computed as if no such amalgamation has taken place, and depreciation so computed shall be apportioned between the Indian branch and subsidiary in the ratio of number of days for which the assets were used by them. So similar provisions there in case of amalgamation of companies, section 32. So what happened is that the depreciation computed as if no this conversion, no this amalgamation has taken place, and whatever the total depreciation for the year, you apportion that depreciation on the number of days for which the assets were used by the assessee. So if the assets were used for, so whatever they are assets of the Indian branch. We are talking about depreciation of assets of Indian branch only. Depreciation of this assets of Indian branch has to be a portion between the branch and the subsidiary. The assets owned by the subsidiary company is the subsidiary company is only eligible to claim the depreciation for the entire year on these assets. There is no question. So the asset which the Indian branch used to hold, I'll compute the depreciation for the entire year as if no conversion has taken place. Say depreciation comes rupees 1000. Now I will apportion this depreciation in the hands of Indian branch and subsidiary in the ratio of number of days for which the asset was held by them, used by them. So if the asset was used by Indian branch say for 180 days and for the subsidiary for 185 days, then I will apportion 1000 in the ratio 180 is to 185. Clear? The similar thing, exactly identical thing happens in case of money machine. The accumulated loss and unabsorbed depreciation of the Indian branch shall be deemed to be the loss or depreciation of the Indian subsidiary for the previous year in which the conversion was effected. So if there was any brought forward losses or unabsorbed depreciation in the hands of Indian branch, it shall be carried forward by the Indian subsidiary. And not only that, the loss shall get a fresh life of 8 years. So the accumulated loss shall be deemed to be the loss of the subsidiary company for the previous year in which conversion was effected. It shall be deemed to be the loss of this year. So now 8 years shall be counted from the year of conversion. Okay. The cost of, here comes the tax neutrality. So for the Indian branch, it has given a benefit of capital gain. Now comes the role of the Indian subsidiary. So for the Indian subsidiary, it will not give the escalated amount, the appreciated cost of the asset. Similar whatever happens in the case of amalgamation. The cost of acquisition in the hands of Indian subsidiary company shall be actual cost of block of asset for the proposed section 43(1). WDV of the block in the hands of branch on the date of conversion. So whatever WDV was there in the hands of branch, the same WDV shall be there in the hands of subsidiary only. No escalation. Actual cost of any asset on which deduction has already been allowed in 35 AD. So WDV shall be nil in the hands of subsidiary company. Any other capital asset, cost for which Indian branch or as the case may be previous owner acquired it. So similarly, there is no incremental cost allowed to the subsidiary company. Whatever the cost was there in the hands of Indian branch, the same shall be allowed in the hands of the subsidiary company only. So this is tax neutral. MAT credit of Indian branch shall be deemed to be the credit of the Indian subsidiary. So MAT credit is also allowed to be carried forward by the subsidiary for the purpose of previous year in which conversion was effected. The provision of section 35DA shall apply to Indian subsidiary company as they would have applied to Indian branch if the conversion had not taken place. Deduction which is allowed in 5 installment. If the Indian branch has already claimed deduction in for 3 installment, the remaining 2 installments shall be allowed to the Indian subsidiary. The credit balance in the provision for bad and doubtful debt account made under section 36(1)(7)(a) of the Indian branch on the date of conversion shall be deemed to be the credit balance of the Indian subsidiary company. You know, this assessee is engaged in the business of banking, and for the banking business, provision bad and doubtful debts are allowed a deduction under section 36(1)(7)(a). So the same credit balance shall be carried forward by the Indian subsidiary. The provision of section 56(2)(10) gift shall not apply to transaction of receipt of share in the Indian subsidiary company by the foreign bank or its nominee in consequence of conversion of Indian branch into Indian subsidiary. So on conversion of Indian branch into Indian subsidiary, the Indian subsidiary shall issue its share to the foreign bank in lieu of the asset acquired of the Indian branch. So foreign bank shall not be taxable under section 56(2)(10) as a gift taxation that it received the share without for less than the it has received the shares and it's not actually incurred the cost. Okay. Date of conversion shall be the date which the RBI appoints for vesting of undertaking of the Indian branch in Indian subsidiary. Okay. We'll discuss accumulated loss and unresolved depreciation of the branch shall be deemed to be the loss or depreciation of the subsidiary company. Now the law says what is accumulated loss. It's simple, the business loss, but for business loss of the Indian branch. Accumulated loss means so much of the loss of Indian branch before its conversion into Indian subsidiary company under the head PGBP, which such Indian branch would have been entitled to carry forward and set off under section 72. So much of the loss which the branch was entitled to be carried forward and set off, such loss shall be deemed to be the loss of the subsidiary company. Similarly, unobserved depreciation means so much of the allowance of depreciation of Indian branch which remains to be allowed and which would have been allowed to the Indian branch under the provision of the Act if the conversion had not taken place. Then it says, in computing the period of holding a capital asset in the hands of subsidiary company, the period for which the asset was held by the Indian branch shall also be considered, shall also be included. Okay, so complete tax neutrality. This completes the topic of Indian conversion of branch into Indian subsidiary. Question is, profit or loss has to be computed as on the date of conversion. Is that right? So what profit or loss you are talking about? If you're talking about the profit on conversion, then such profit, the capital gain is actually exempt under section 115 JG. Okay. But if you're talking about the profit, business profit up to the, see, whatever, what will happen is that conversion shall happen on a date. Say it happens on 1st October. So up to 30th September, the branch was doing some business. Now, such business shall be done by from 1st October by the subsidiary company. So branch will, on conversion from branch to subsidiary company. So branch will actually file return for its period, for the period from 1st April to 30th September and will pay tax on the profit it made during this period, taxable. Okay. But if you're talking about the profit or loss on conversion from branch to the subsidiary company, this is the precise profit which we discussed shall be exempt under section 115 JG if it satisfies the condition provided in the scheme of the RBI or the notification issued, which we just discussed, that the amalgamation is on the approval of shareholders of the branch, which is foreign bank, and the subsidiary shareholder of the foreign bank. All assets are transferred, assets and liability are transferred book value. The foreign bank holds the shares of Indian subsidiary company. And lastly, what was the last point? That foreign bank is not getting anything other than the shares of the Indian subsidiary company. Okay. Let's see a small PPT on this, just to revise the concept very quickly. So section 115 JG, conversion of foreign bank branch. So it's apply only if the foreign company, the branch is of foreign bank, means a banking branch. Purpose, RBI encourages foreign bank to convert in branches into subsidiary company. Tax neutrality is provided. You understand the concept of tax neutrality? Tax neutrality means no tax in the hands of seller and no incremental cost in the hands of buyer. This tax neutrality runs through the entire section 47. Main tax benefit, no capital gain tax on conversion, smooth continuation of banking business. Key consideration, conversion should be as per RBI approved scheme, okay, and it should be approved by the shareholder of the foreign bank and shareholder of the Indian subsidiary, okay. All assets and liabilities should be transferred. Transfer should be at book value, revaluation to be ignored. As the condition, Foreign bank only receives shares, doesn't receive anything other than the shares, no cash, nothing, no cash or other consideration. And foreign bank actually maintain 51% shareholding for the next 5 years in the Indian subsidiary company. Accumulated losses shall be carried forward. Accumulated losses or unabsorbed depreciation of the branch shall be deemed to be the loss or depreciation of the subsidiary company, and subsidiary company shall be eligible to set it off against its profit. Treated as loss of the Indian subsidiary company. Depreciation in the year of conversion. So if the conversion happens in the mid of the year, not on 1st September, but during any day between the year, then you will compute the depreciation as if no conversion happens and apportion the depreciation on the number of days. Which number of days? Number of days the asset were used by the branch and the subsidiary. Similar to loss and depreciation, MAT credit of branch shall also become credit of the subsidiary. Also, bad debt provision 36(1)(7)(a) shall continue in the hands of subsidiary company. If the conditions are violated, then benefit withdrawn. AO shall recompute the income of the year of conversion. And rectification of section 154 and 4 years shall be reckoned from the end of the previous year in which this violation occurred. Okay, understood? Let's quickly revise section 44C as well, the HO expenses which we discussed. Section 44C HO expenditure. What is section 44C? Applies to foreign companies or non-resident. They incur expense at HO, head office outside India. Okay. India allows deduction but with restriction. Deduction has to be allowed because they are incurred for the Indian branches, and restriction because it is practically difficult for the department to actually verify these expenses. What are HO expenses? Rent, electricity, insurance of foreign office, salary, travel of foreign executive, general administrative expenses. So these are only illustrative ones. They are not exhaustive ones. So the question will not come whether it's a HO expense or not. The question is how much of HO expense is allowed as deduction. Okay, you're getting the point. Why restriction is imposed? This is important. Indian tax officer cannot verify foreign expense easily. You got the point? Risk of inflating expenses to reduce Indian income. Hence, a reasonable cap is fixed. So, government has not taken any of the extreme steps. They have taken a mid route. They said that reasonably 5% of your income, I'll accept such a deduction. I can tolerate 5% of your income as HO expense. This is also the maximum amount. How much deduction is allowed? Lower of 5% of adjusted total income or actual HO expense related to Indian business, whichever is less. So you should show the comparison and then conclude that 5% is lower and therefore I am allowing 5% in the exam. Don't do this in your mind only. Now, what is adjusted total income? Means total income before deducting HO expenses, brought forward loss on absorbed depreciation, chapter 6A deduction, and capital expenditure on family planning. If adjusted total income is a loss, then what we do? You know, if adjusted total income is a loss, then we compute the average adjusted total income of the last 3 years. But if the Indian branch is present for less than 3 years, then I compute the average for whatever year the Indian branch is there. So 5% of the average adjusted total income, average of immediately preceding 3 years. If less than 3 years, take available years only. Okay. So this take available years or all this phrase is retained in your mind. If I try to revise it so that you actually absorb the concept and it retains with you. Simple example. Adjusted total income 100 crores. So 5% 5 crore. Actual expense 8 crore. I will take the lower, which is 5 crore. Had the actual expense being 4 crore, then I would have allowed a deduction of 4 crore. Deduction cannot exceed the actual, but it has to be limited to the 5% of the adjusted total income. Okay, dear friends. So we discuss two provisions, section 44C and section 115JG, means conversion of branch into subsidiary company. Now we'll stop, we will pause for a break of 10 minutes. Then we again assemble and do the remaining part of the this chapter. Okay. Okay, so let's start again. So in the first half, we discussed the actual expenses and the benefit which the law provides on conversion of a branch of foreign bank into the Indian subsidiary. So now the next provisions. One very important for India. Section 9A. See, I'll tell you the background. We partly discussed the issue, the problem at the in last class as well when we were discussing IFSC. So what happens is that there is a investment funds, investment funds which are being managed by the people, and the one who manage them, we call them fund managers. So they are actually, who is the fund manager? What is the what these investment funds do? So if you know what the purpose of this investment fund is, to collect the money from the public, from different people. They accumulate the money, they ask for the money, and they got a big amount of corpus as a contribution from different members, and they invest this corpus into the shares of the various companies, and they make profit, they charge their commission and distribute the balance profit as a dividend to the members. So this is a vanilla investment fund works. Who is the main person here? Is a person who fund manager who actually decides where this money is to be invested so that higher return can be obtained from this investment. So these are the people who understand the share market, who understand which sector will grow, which doesn't grow. So they are highly technical, analytical people. You know, this is one of the very rewarding field as a chartered accountant. So if you want to get into the as a fund manager into the equity research companies, so this is also one of the very rewarding field for you. You know, the salary package are best in the industry, in this field. But of course, this actually requires a highly skilled people, to decide where to make an investment, and the corpus corpus runs somewhere from 100 crore to thousands of crore. You know. So you have such a big responsibility on your shoulder. You're investing such a big amount. So, but if you can actually get good returns, good than the your peers, then your market value is really good. You will get a good perks, good salary, good incentives, very good incentive. Okay, we understood what's investment fund do, what's and who is a fund manager. Is a fund manager means the person who actually manages the funds of this investment fund. Okay. Now, what happens is that most of these fund managers are Indian. Why? Because we all know the brain, the Indian people are quite intelligent, as you are. Huh? So is you, but they don't operate from India. Though they are Indian, but they don't operate from India. And one of the major reasons that they don't operate from India is the tax laws. Why? I tell you. See, assuming there's an investment fund which is incorporated in Singapore. Okay. These funds are incorporated in the form of trust, company, whatever. Now, the fund is being managed by a person, Mr. A, who stays in India. Now, what may be the tax consequence? Can you tell me? Can you tell me if this Mr. A stays in India and is a fund manager of an investment fund which is incorporated in Singapore, then because of his stay in India, what would be the tax consequences on the investment fund? We are talking about the investment fund. One of the answer is income taxable in India. So he's saying that income of investment fund is taxable in India. I am looking to know why. Why you said that income of this investment fund is taxable in India? Because the fund manager is staying in India. Is this the reason that makes the fund income taxable in India? And if you say yes, then tell me under which provision, how? I tell you. I tell you. One of the consequence, the conclusion which you told that income is taxable in India is perfectly fine. This is the of course, this was is the major roadblock because there is a doubt, there is a fear that if the fund manager is staying in India, then it will expose this his stay in India will expose the income of investment fund to India taxation. But why? I'll tell you. One, there's a possibility that a business connection may be constituted because he is the one person who is taking a decision, who is the main person who where the only his activity is generating the income. You know? So if he's staying in India, there's a business presence of the investment fund in India. Secondly, his stay in India may be considered as that decision making, or I would say the brain of the fund is in India, and therefore the fund shall qualify as resident in India, and therefore its income is taxable in India. You're with me? First, there's a possibility that the fund may constitute a business connection, and there's also a possibility that the fund may qualify as a resident in India because only because his fund manager is staying in India. And if a fund is held to be a resident in India, then its global income from the investment made outside India, shall also be taxable. Okay. So because of these reasons, this fund manager used to work from Singapore, Dubai, but not from India because of this tax consequences. But bring them into India, Section 9A was introduced, which says that, which gives, says that the intent is if this exempts this clear out this fear that if the fund manager is staying in India, then it clarifies that in such case the investment fund shall not be treated as having a business connection or treated as a resident in India. So it clears this fear. There was a fear, because of tax authority may argue that the activities of fund manager has resulted in business connection or would make the fund as a resident in India. So this section 9A clears out this fear, said that as in explicit term that if fund manager is staying in India, it will not expose the fund to India taxation. Okay. So this was an incentive given to the fund managers so that they can work while staying in India. Okay. Let's see. First, let's see the problem. The provision section 9 deal with income which are deemed to accrue or rise in India. Yes. Section 911 provides a set of circumstances in which income is deemed to accrue or arise in India and is taxable in India. One of the conditions for the income of a non-resident to be deemed to accrue or rise in India is the existence of business connection in India. So if the non-resident has a business connection in India, then his income is deemed to accrue or rise in India and therefore taxable in India. We are talking about non-resident. Who's non-resident? The fund. Once such a business connection is established, the income attributable to the activities which constitute business connection becomes taxable in India. Similarly, under DTAA, the source country assumes taxation right on certain income if non-resident has a PE, permanent establishment in India, in that country. In case of offshore funds means the funds incorporated outside India. In case of offshore funds, under the above provision, the presence of fund manager in India could create sufficient nexus of the offshore fund with India and could constitute a business connection in India, business connection of the fund in India, even though the fund manager may be independent person. There is a possibility of such an allegation from the tax department. Similarly, if the fund manager is located in India, he undertakes fund management activity in respect of investment outside India of the offshore fund. So though the fund manager is located is staying in India, but he is investing in the shares of a foreign companies. You know? The profit made by the fund from such investment could have been liable to tax in India due to the location of fund manager. Because though profit is earned outside India, but it's from the activities which was undertaken in India, so the tax authorities could have argued that this profit is taxable. An attribution of such profit to the activity of fund management manager undertaken on behalf of offshore fund. Therefore, apart from taxation of income received by the fund manager as fee for fund management activity, the income which the fund manager is driving from the fund is taxable in India. No conflict, no issue on that because fund manager is actually staying in India. But in addition to that, income of offshore fund from investment made in countries outside India may have also got tax in India due to such fund management activity undertaking in and from India, constituting a business connection. So the fear is you will tax the tax department, Indian tax department will tax the the fund income from investment outside India into India. Okay, to the Indian taxation. Further, presence of fund manager under certain circumstances may have led to offshore fund being held to be resident in India on the basis of its control and management being in India. You understood? The two fear, two doubts that the stay of fund manager in India, the location of fund manager in India, may expose the fund to Indian taxation by either by saying it has a business connection in India, or in extreme situation, the tax authority may allege that the fund is itself a resident in India, and therefore no question of attribution. The entire income is taxable in India. There are a large number of fund managers who are Indian origin and are managing the investment of offshore funds in various countries. These persons were being discouraged from locating in India due to above tax consequences in respect of income from investment of offshore fund made in other jurisdiction. You're getting the point? So in order to facilitate location of fund manager of offshore fund into India, a specific regime has been provided in the Income Tax Act in line with international best practices with the objective. What is the objective of Section 9A? That subject to fulfillment of certain conditions by the fund and fund manager, the fund shall not be considered as having a business connection or being resident in India. Okay. So let's see the provision. Now you got the background why the Section 9A is there. What Section 9A says? An eligible investment fund shall not constitute business connection in India if its fund management activity is carried out through an eligible fund manager. So first, it clears out, it clarifies that the fund shall not be deemed to have shall not be considered to constitute a business connection in India. An eligible investment fund shall not be said to be resident in India merely because the eligible fund manager undertaking such management activities on its behalf is situated in India. So merely because the fund manager is staying in India, this fact alone will not make the fund as being resident in India. You understand? There are two different persons, fund and fund manager. So what they are doing? They are exempting the fund from constituting a business connection or from becoming a resident in India if solely because of its fund manager staying in India. Okay. So they are saying If your fund manager is staying in India, no worries. This alone fact will not expose you to Indian income tax. Nothing contained in this section shall apply to exclude any income from total income of the eligible investment fund, which would have been so included, whether or not such fund constitute a business connection in India. So, if there is some income which was taxable in India even without the fund constituting business connection in India, such income will continue to be taxable. You're with me. We are giving an exemption that your stay of your fund manager will not expose you to any additional tax. Whatever tax which you are otherwise liable to pay in India, you will be liable to pay. Logical also, fair also. Now it uses the terms, two terms, eligible fund and eligible fund manager. Now we'll see the meaning. So, eligible investment fund means a fund established or incorporated or registered outside India. We are talking about the foreign funds and offshore funds, which fulfills the following condition. The fund must fulfill all these following conditions. Only then Section 9A benefit shall be provided. The fund is not a person resident in India. So, fund without this fund manager activity is otherwise not a person who is resident in India. Is incorporated outside India and its control and management is outside India. The fund is resident of a country with which India has DTL. So, fund is actually a resident of a country with which India has entered into a double taxation avoidance agreement, or is established, incorporated, or registered in a country notified by the central government. The fund is subject to applicable investor protection regulation in the country of its incorporation. Okay. Aggregate. So this point is towards the fact that fund is actually an offshore fund. Aggregate investment in the fund by person resident in India does not exceed 5% of its corpus as on 1st April and 1st October of previous year. So in every year, on 1st April, on 1st October, I have to see that the investment which I have got, the corpus which I have got from different people, is how much is it from the resident and how much is it from the non-resident. So investment from resident cannot exceed 5% of the total corpus. Okay, so it's basically the non-resident investing in offshore funds. Okay? So you see the power of Indian. The money is of non-resident, the fund is offshore, but who is managing? The Indian people is managing. The Indian person is managing the money of non-residents. Only 5% of the money is from resident. So his benefit is only to the funds which are actually investing the money of the non-resident people. Contribution made by eligible fund manager during first 3 years of operation of the fund shall not be considered if the same does not exceed 25 crore. So it says what happens is that when the fund is incorporated, the fund manager normally invests its own money so that the member, the other people, actually gains a confidence that he has actually invested his own money, so he will be serious about the investment of the money. He will take care of the money of these people as well. So, if that has not been excluded, then this 5% condition would have been violated. But there is a genuine problem. Practically, during the start of the phase of the fund manager actually has to invest its own money, and therefore it has been excluded from while computing this 5% limit. Secondly, further, if aggregate investment in the fund exceeds 5% on 1st April and 1st October of the previous year. So, if this 5% investment exceeds, so this condition is violated, then also the benefit is there, provided the condition mentioned above will be deemed to be satisfied if the fund reduces its aggregate investment to 5% or less within 4 months from 1st April or 1st October of such previous year as the case may be. Okay. So the fund has a time of 4 months. to reduce the percentage of investment by resident to below 5%. Okay. If it does so, then he will continue to be qualified as eligible investment fund. Okay, the question is, this aggregate investment of 5% in India or outside India? No. See, Sanjay ji, I'll tell you. These are two different things. This is the fund. What the fund does, it accumulates money from different people and creates a corpus. And then it invests the corpus into the shares of different companies. These shares may be of Indian company or outside company, right? Or outside India. In this point, we are dealing with this side, the side where the fund collects the money, gets the money. So we are saying the people who has actually contributed to the fund should primarily be non-resident. The total, if the total investment, the total corpus is 100 rupees or 100 crores, the amount which the fund has received from the resident should not exceed 5 crores, should be less than 5. We are not talking about the investment which the fund has made into the India or outside India. We are just in this point, we are concerned from where the fund is getting the money. So primarily the fund should get the money from non-resident. Okay? Clear? If they went out, do let me know. Okay, got it now. Thank you. Second, the fund has a minimum of 25 members who are directly or indirectly not connected persons. So what this point says, the fund should not be a very close fund. It should not be a fund of one group of people. The fund should have at least 25 members which are not connected, 25 independent people. Any member of the fund along with connected person shall not have any participation interest directly or indirectly in the fund exceeding 10%. So all these 3 points are in respect of this side, the side from which the fund is collecting money. So first, the money it collects from residents should be below 5%, up to 5%. Second, it should collect money from 25 or more independent people. Thirdly, it should not be something like that there are 50 people, but the one person has actually invested 99%, and the rest 49 has only aggregatedly invested 1%. So these 49 are dummy. So it says there should be 25 independent people, and each of them should not exceed the investment by each of them should be less than 10% of the total corpus, so that all are actually genuine investors. Okay. So for it says, first it says the fund has a minimum of 25 members who are directly or indirectly not connected person, 25 independent people. Then it says any member of the fund along with connected person shall not have any participation interest directly or indirectly in the fund exceeding 10%. So all are actually genuine investors. No for the namesake. Then also it says the aggregate participation interest of 10 or less members along with their connected person in the fund shall be less than 50%. So it says each person should have less than 10% and the aggregate of 10 should be less than 50%. Okay. All this thing to ensure that the fund is actually a genuine fund. Fund shall not invest. Now we are talking about the investment, other side. The fund shall not invest more than 20% corpus in any entity. So the fund should not be funding only one group of entities. The fund shall not make any investment associate entity. It will not make any investment in its own related entities. The fund is neither engaged in any activity which constitutes a business connection in India, nor has any person acting on his behalf whose activity constitutes business connection in India other than the activities undertaken by the eligible fund manager on his behalf. Except the activity of eligible fund manager, there is no other condition, no other activity, no other work which the fund is doing, which constitute a business connection in India. Okay, it's otherwise not constituting a business connection in India, except for the activity of fund management. The monthly average of the corpus of the fund shall not be less than 100 crore, except in case of fund which has been wound up in the previous year. So we're not talking about small funds. We're talking about that the fund must have a minimum corpus of 100 crores. If fund is established in the previous year, we're talking about the year in which the fund is established. The corpus of the fund shall not be less than 100 crore on expiry of 12 months from the end of the month of establishment. So if in the previous year your corpus is less than 100 crore, acceptable. But within 12 months, you must raise the corpus up to 100 crore. And then you are eligible investment fund. The fund shall not carry on or control and manage directly or indirectly any business in India. The remuneration paid by the fund to the fund manager in respect of fund management activity undertaken by him on its behalf is not less than the amount calculated in such manner as may be specified. Okay, so it gives a reasonable amount of remuneration to the fund manager. If all these conditions are satisfied, then the fund shall qualify as eligible eligible investment fund, and shall be eligible to Section 9A benefit. So what are the Section 9A benefit? One, it shall not be deemed to constitute business connection in India. Second, it shall not be deemed to be a resident in India. Only because its fund manager is staying in India. What if it becomes less than 100 crore? Will it be taxable? See, it might be taxable, it might not be taxable. Then it will not be eligible to Section 9A. It will not qualify as eligible investment fund. Then, if its fund manager is staying in India, then its activity of the fund manager may expose the fund to Indian taxation. Okay. So, all these conditions are only to ensure that the fund is actually a genuine fund. So it has fairly reasonable amount of members. It's not concentrated. Its investment is also not concentrated into a group of entities. It cannot invest more than 20% of its corpus into one entity. Then it's incorporated outside India. It's otherwise not doing any activity which constitutes business connection in India. Okay. Now it says conditions specified in E, F, and G. E, F, and G. We are talking about the members. E, F, and G means the members must be 25 or more. No one member should have a participatory interest of more than 10% in the corpus, and the aggregate interest of 10 members should not exceed 50%. Okay. So these three conditions not applicable. A benefit is given to which fund? These three conditions are not applicable to an investment fund set up by the government or central bank of foreign state. So a fund is set up by a foreign government or central bank like RBI, central bank of foreign country, or a sovereign fund, or such other fund as a central government may by notification in the official gazette specify in India. If the fund is actually set up by the government of a foreign country, then in such case, generally it doesn't have a member. The member is only the government. The government only has the money which it gives to the fund for management. So in such case, this condition will be violated. So it is a exemption given to the fund which are actually owned by the government of the foreign country. Okay. Then the similar exemption is given in case of IFSC as well. What it says? Further conditions specified in EFG, similar, 25 members, each member holding less than 10% interest in the corpus, and aggregate interest of 10 members less than 50%. Conditions specified in clause EFG shall not apply in case of eligible investment fund and its eligible fund manager if such fund manager is located in IFS. So if fund manager is located in IFSC in the Gandhinagar gift city, then also even if the fund has a lesser member, it will still qualify as eligible investment fund. And the fund has actually commenced operation before 31st March 30. Also, such fund shall not. Such fund means a fund of which the fund manager is operating from IFSC. Such fund shall not be considered as controlling or managing any business in India if such fund undertake any activity, including right to appoint director or executive director, as a monitoring mechanism to protect the investment in such person. So what it says, such fund has actually invested in India, okay, in India, and to protect its investment in the Indian company, what this fund is doing, he is actually appointed director into the company, appointed director in such company. Now, one of the conditions of eligible fund is that the fund should not control manage business in India. Once you are actually appointing director or executive director in the Indian company, it somebody may very well allege that you are actually controlling managing the business in India. But if your fund manager is located in IFSC, then if you are appointing a director only to protect your investment in such company, then shall not be considered as you're doing business in India. You're controlling or managing any business in India. Okay. So for IFSC, two benefit. One, the condition of 25 member, one member having more than 10% share, or aggregate 10 member having more than 50% share is not applicable. Sorry. And second benefit, if the fund actually appoints a director or has a right to appoint a director or executive director in India, in an Indian company. But such appointment, such right is only to protect its investment in such company. Then shall not be treated, such right shall not be treated as the fund is controlling or managing business in India. Okay. Now we understood the meaning of fund, eligible investment fund. Now we will see the meaning of eligible fund manager. Means any person who is engaged in the activity of fund management and fulfills the following condition. What is the condition? The person is not an employee of the fund, eligible investment fund, or connected person of the fund. So, independent person is not an employee. Second, the person is registered as a fund manager or investment advisor in accordance with the specified regulation. The specified regulation may be the regulation of SEBI or IFSC regulation, as the case may be. The person is acting in the ordinary course of his business as a fund manager. The person, along with his connected person, shall not be entitled to more than 20% profit of the eligible investment fund from transaction carried out by the fund through such fund manager. So he's not entitled to more than 20% of the profit in respect of transaction carried out by him. Okay. If he fulfills these four conditions, then he will qualify as eligible fund manager. And if he qualifies eligible fund manager, then even if he stays in India, his stay in India will not expose the fund to Indian taxation. Okay. Now, it says associates mean an entity in which a director or a trustee or a partner or a member or a fund manager of the investment fund, a director, trustee, partner, or member of the fund manager of such fund holds either individually or collectively share of interest being more than 15% of its share capital. So if you have a more than 15% interest in another entity, you will be as associate. Okay. The question is there any specific qualification exam which is required for becoming fund manager? Yes. So under SEBI regulation, there is a condition, there is an exam, and I think there's an experience also to qualify as a fund manager. Only then you get a certificate as a fund manager. So it seems that Sanjay is having an interest to become a fund manager. Good. It's actually a very good field to practice. And nowadays, very easy to get the information how to become a fund manager. You all people know. Every eligible investment fund shall within 90 days from the end of financial year furnish a statement in the prescribed form to prescribe income tax authority. So every eligible investment fund has to furnish a statement within 90 days. If eligible investment fund fail to furnish a statement within the time prescribed, the prescribed income tax authority may direct that such fund shall pay by way of penalty a sum equal to 5 lakh rupees. Okay, so there is a penalty of 5 lakh rupees on the fund. You understood? Section 9A. We discussed this in great detail. Now let's just revise through the PPT. Offshore fund managers in India. Problem faced by offshore fund. Fund manager is located in India. Risk of business connection in India. Risk of Indian residency of fund. You understood? Because of the activities of fund manager who is staying in India. Objective of Section 9A to encourage fund manager to operate from India, prevent taxation of foreign investment into India. So any income which you earn from foreign investment is not taxable in India. This Section 9A ensures. Main relaxation provided: no business connection due to fund manager, no residency merely due to fund manager in India. Okay. Eligible investment fund, key condition. Fund should be established outside India in a country with which the India has DTAA or any other notified country by the central government. The investment from residents should be less than 5% of the corpus investment into the fund, not the investment of the fund. Sorry. Minimum 25 independent investors. No investor having a more than 10% interest in the corpus, and the corpus should be at least of 100 crores. If it's a year of setup, then this 100 crores should be achieved in 12 months from the month in which it is set up. Investment. Now we are talking about the investment made by the fund. You know, maximum 20% investment in one entity and no investment in associated entity of the fund itself. So we understood the meaning of associate as well. If your partner, director, trustee, any other person have a interest more than 15%, then such entity shall be deemed to be an associate. Now, what are the conditions for the fund managers? He should be independent, should not be an employee, SEBI registered or IFSC registered, and profit share should be less than 20% of the transaction routed through him. Benefit provided to IFSC that is available to if the fund is established up to 2030. And what are the benefit? The condition of E, F, and G, which is E is 25 independent members, F is less than 10% stake in the corpus, and G is less than 50% stake for aggregated 10 people. These conditions are not applicable. And also, if the fund has a right to appoint directors in the Indian company, then it will not be treated as the fund is managing or controlling the business in India. If such right is there only as a monetary mechanism to protect the investment of the fund in such company. Okay. So we discuss section 9A. Now we are left with very, very small sections. Section 285. In section 285, it says every person being a non-resident having a license office in India shall furnish a statement to the AC in respect of its activity in a financial year within a period of 8 months from the end of the financial year. So if a non-resident has a license office, what is license office? I tell you. Non-resident generally operate in India either having a branch office, the foreign companies, or having a license office, LO. LO, both, whether you want to open a branch office or you want to open a license office, you need a permission of RBI. So what's the difference? When you take a permission of RBI to open a branch office, The RBI allows you to do business in India. So branch is very wide. It can actually do any business in India. RBI allows the non-resident to open a branch office, meaning the RBI is allowing the non-resident to actually do business in India. So clearly, if a non-resident has a branch in India, it has a business connection or PE, and therefore it's taxable in India. Yeah, this is vanilla case, no doubt. If a non-resident has a branch, it's taxable in India. What is activities of the branch? What is branch activities? But this another thing, LO, license office. This is also open with the approval of RBI. But in this case, RBI restricts that your activity shall only be limited. Your means the activity of the license office, activity of the non-resident in India shall only be limited for licensing. Licensing for purchase of goods. You're only acting as a communication channel. You're not doing any business. You don't have any decision making. You're just communicating things from one person to another, from India to your HO, to outside India, or from HO to India, to Indian people. You're not doing any other thing. You don't have any decision making, nothing. You're just a communication link. So activities, this precise activities of LO does not constitute business connection. So practically what the NR wants that I am only doing liaison office activities. Yeah. But practically what happens is that they at the time of opening the office, what the non-resident says, what the foreign company says, I actually want to do the licensing activity only in India. I will not do any business in India. I'm only acting as a communication channel. I'm opening a communication office in India. So they take the permission from RBI as if they're opening a LO. Yeah. But practically, subsequent year, as the year goes by, practically they expand their activities, and their activities goes outside the communication activities. They do more than what they were allowed by RBI. So to actually keep a check what they're actually doing, there's section 285, which says that every year you will furnish, the non-resident having a LO shall furnish a return of its activity, what they're actually doing in India, within 8 months from the end of financial year, so that the tax officers, the tax authorities, the regulatory authorities of India actually ensure that you're doing what you are permitted to as LO, so that it should not happen that you're actually doing business in India and not taxable in India because you are registered as LO. Okay, got it? Section 228A. This is recovery. Recovery. Two-way recovery. I tell you. What happens? There may be a situation that a NR is there which is liable to pay India tax, and he is not paying that. Then the Indian government wants to recover it, this Indian tax, from this NR. There may also be a situation that there may be a tax of the foreign government, which the foreign government wants to recover from a person, and such person has an Indian asset. You understood? There may be receivable by the Indian government. Indian government may want to receive something from NR. And there might be a position that foreign government may also want to receive something from some person, and such person has Indian asset. Then what happens? Generally, the governments of different countries, including India, enter into agreements where they say that we'll cooperate with each other if they can for the tax outstanding tax amount which they can help to the other government to collect. Okay, so they will help the India will help the foreign government to recover its tax dues, the tax dues of foreign government, and similarly, the foreign government will help the Indian government to recover its tax dues. And this happened through section 228A, 228A, where it says, where the government of a foreign country with which India has entered into double taxation avoidance agreement sends to the board. Board means CBDT. Sends to CBDT a certificate for recovery of any tax due from a resident. So there is a person who is resident in India and is required to pay tax in foreign country, say in Singapore. Then the Singapore authorities may send a recovery certificate, may send a certificate specifying the amount which is to be recovered from this person. Or it may happen that such person may not be resident in India, but such person have any property in India. Then also the Singapore authority may send a certificate to the CBDT, Indian board. The board then may forward such certificate to tax recovery officer, TRO, having jurisdiction over the person, over the resident, or within whose jurisdiction such property is situated, and thereupon such TRO shall proceed to recover the amount specified in the certificate as if it is a certificate drawn up by him under section 222, as if it's actually Indian tax dues, and remit any sum so discovered not to the Singapore authority but to the board. TRO has jurisdiction only up to the board. So he will remit the amount so recovered to the board after deducting his expenses in connection with the recovery proceeding. Okay, what does it say? The foreign government is required, it has some tax dues against a person. So if such person is Indian resident, is a resident in India, Indian resident, or he is not an Indian resident, he is NR, but it has some property in India, then both these cases, the foreign government, assuming Singapore authorities, will send a certificate of tax recovery to the CBDT. And CBDT shall forward this certificate to its TRO. Whose TRO? If this person is Indian resident, then to the TRO who has jurisdiction over this resident, in whose jurisdiction the PAN of this resident falls. If such person is not an Indian resident but has a property in India, then to the TRO who have a jurisdiction over such area where such property is located. Then what this TRO will do? He will recover the amount from the assets of this person, and whatever amount recovered, he will deduct the recovery expenses and shall remit the balance amount to board itself. And then board will decide whatever it want to do with the amount. He will pay to the Singapore authority or not. That's not our question. Our jurisdiction, our topic, our course is only limited to the income tax. But the big people, the CBDT will do is not in our part. So you understand about when there is a dues of foreign government. When assessee in default deemed to be in default in making payment of tax, the TRO may, if the assessee is a resident of a country with which India has entered into DTAA or has any property in that country, forward to the board a certificate drawn by him under section 22. Now we are talking about the dues of Indian government. So if there is a due which is against the person who is resident of another country, resident of a Singapore, assuming. So who is a non-resident here, but who is resident of Singapore, then the TRO may draw a recovery certificate and forward it to the CBDT and request CBDT to forward it to the Singapore authorities. And the board may take such action thereon as it deem appropriate, having regard to the terms of the DTAA with such country. Then board will decide depending upon situation upon the agreement which it has with the such country. So now similar situation, if the dues are of Indian government in respect of a person who is resident of a foreign country, assuming a Singapore in our case, or who is not a resident of Singapore, who may be resident of UK but it has property in Singapore. So, assuming there is Mr. A, who, though is a resident of Singapore, has a property in UK, then the TRO shall draw a certificate and forward it to CBDT. Then CBDT may either forward it to the Singapore authorities or to the UK authorities or to both the authorities, to collect its tax revenue. It is up to CBDT. Okay. Then we have section 163. I think second last section for today's class. Yes. Very much important. And it has a lot of practical usage, practical applicability. What is section 163? Section 163 is the representative assessee, agent of non-resident. So it is very difficult to collect tax from the non-resident. Section 163 assumes some person in India as the agent of non-resident from whom the Indian government can collect tax. So this power to treat any other person as agent of non-resident is given by section 163. So section 163 says agent in relation to non-resident include any person in India who is employed by or on behalf of non-resident. If there is any person in India who is an employee of non-resident, then the Indian government may treat such employee as his agent of the NR. So if there is a foreign company, it has an employee in India, the Indian government may treat the employee as agent of the foreign company. Who has business connection with the non-resident? So if the foreign company has an agent in India, which constitute as a business connection of foreign company in India, then the Indian government may treat the agent as the agent of foreign company for the purpose of section 163. From or through whom the NR is in receipt of any income. If NR has any debtor in India, then the Indian government may treat that such debtor from whom the NR is receiving income as the agent of NR. Who is trustee of the NR? In such case also, such trustee can be treated as agent of the NR. Who, whether a resident or non-resident, has acquired by means of transfer a capital asset in India from the NR. See, this is important. E. Any person who's actually bought a capital asset in India from the non-resident. And such person may also be a non-resident. So even if a NR seller is selling to another NR, then the buyer, who is NR, can be treated as an agent of this NR seller, provided the asset which is transferred is situated in India. Okay. So the 4% in clause A, B, C, D, they should be in India, but the fifth expanded scope, and if there is a transfer of a capital asset in India, then even an NR can be treated as an agent of another NR. Okay. A broker in India who does not deal directly with NR. So what is this person saying? They are saying sub agent cannot be treated as an agent. So there is a NR principal. He has a broker who is also NR, and the person in India is dealing. He is a sub broker. He is dealing with this broker. Then this sub broker cannot be treated as an agent. What it says? A broker in India who does not deal directly with the non-resident principal, but deals with a non-resident broker, shall not be deemed to be an agent under this section in respect of such transaction if the transaction are carried on in the ordinary course of business through the first mentioned broker, through the NR broker. The non-resident broker is carrying on such transaction in the ordinary course of his business and not as principal. So both are acting in the ordinary course of their business. Now lastly, since you are treating one person representative assessee, you shall give him an opportunity of being heard. No person shall be treated as an agent of NR unless he has had an opportunity of being heard by the agent. Okay. So this was section 163. Now, section 285A. What is this? If you remember, we discussed Vodafone transaction. What happened in the Vodafone transaction is that there was a Netherlands company which has a subsidiary in Cayman Island as CGP, which has a subsidiary in India, Hutch India, right? Now, the share of this CGP was sold to Vodafone UK by the Netherlands company. This share was transferred. So, Supreme Court said that this is not taxable, but there was amendment brought in section 9, in section 214, 247, by which this share of a foreign company was held to be situated in India and therefore taxable. Right? Simple. In this case, the amendment was to the effect that by transferring these shares, the management and control of this company has also been transferred. We discussed this in detail. Now, the law is in place. Okay, if you transfer the shares of the holding company of the India, then they may also qualify as assets situated in India, provided they derive their value from substantial value from the asset in India. And therefore, in such case, there would be tax liability in India. But the question comes, how would the Indian tax authority come to know about such a transfer? In this case, they were very vocal. A lot in every newspaper it was there that Hutch India has been sold to the Vodafone. Now Hutch will be Vodafone India and all these things. You know? Indian authorities came to know. But it may happen that there is a group which has a company in UK, then they have a company in Singapore, and then they have a company in India. And this Singapore company is being sold to another company, say in USA. Then how would because there is a transaction between a non-resident to and another non-resident, and the shares of a foreign company being sold. So there is nowhere India is involved. How would India come to know? Because for India, the holding company remains Singapore only. Earlier also it was Singapore. Now also it was Singapore. The only difference is in place of UK, now it is USA. But this transaction is not be under the Indian regulatory laws. There is no reporting to the Indian tax authorities or Indian regulatory authorities or Indian Companies Act, whatever. And therefore, this provision came so that Indian governments actually come to know about such a transaction, only then they will be able to tax them. You know? Section 285A says where a company referred to in explanation 5 of section 911. What is explanation 5 to section 911? That a company whose shares are deriving value from the Indian assets and therefore deemed to be situated in India. Where a company directly or indirectly have assets in India through or in Indian concern, then such Indian concern shall furnish within the prescribed period to the prescribed income tax authority the prescribed information. So 285A casts an obligation on this Indian company that they say that my ultimate holding has been changed. The Indian company must be knowing that an obligation is cast on this Indian company to report to the tax authorities that my ultimate holding has changed. Who is this Indian company? This is the Indian company from which this Singapore company is deriving substantial value. The information has to be furnished in Form 49D. You need not to remember the form number. Within a period of 90 days from the end of the financial year, in which a transfer of such share or interest referred above take place. So whenever this transfer took place within 90 days, the Indian company has to inform to the tax authorities, Indian tax authorities. However, if the share or interest has the effect of directly or indirectly transferring the right or management or control in relation to the Indian concern, The information has to be furnished within a period of 90 days from the transaction. So if this transfer of share have the effect of transferring the management or control of Indian company, then the information has to be furnished within 90 days from the transaction. Otherwise, the information has to be furnished within 90 days from the end of the financial year in which transaction took place. See, the management control of this Indian company is with the Singapore company, right? But and it remains so even after transfer of the shares of Singapore company. But if the management of this Indian company was earlier with the UK company, meaning thereby the Singapore company was a conduit or a shell company. And by selling the share of Singapore company, it's actually a UK company has transferred the management and control of the Indian company to the USA company. Then this clearly capital gain taxable in India on account of transfer of this Singapore company to the USA company. And therefore, Indian government wants information within 3 months, within 90 days from the date of transaction. Now the Indian government will not wait to the year to end, but it wants information within 90 days. Okay. 271 GA. Failure to furnish information document section 285A by Indian concern. If this Indian company does not furnish 49D to the Indian government, then what is the penalty? Penalty 2% of the value of the transaction. You're getting the point? Such a huge penalty. 2% of the value. Value means the value for which the shares of Singapore companies are being transferred. 2% of such value. In respect of which such failure has taken place if the transaction has the effect of transferring the management or control in relation to Indian concern. If this transfer of Singapore share has the effect of transferring the management and control of the Indian company, then the Indian company is required to intimate to furnish Form 49D within 90 days from the date of transaction. And if Indian company fails to do so, then the Indian company is liable to penalty equal to 2% of the transaction value. What is transaction value? Transaction value between UK and US. Yeah, such a huge penalty. Or if in any other case, it's 5 lakh. Okay. So, my dear friends, this completes our chapter 21 of your ICAI module and our taxation. I have tried to discuss each and every provision in great detail. Now, what we will do, we'll quickly revise whatever we have discussed in this last 5 classes. Okay. Before this, let's revise this miscellaneous provision with the help of PPT. Miscellaneous international tax provisions. Section 285 license office. What it says that the NR who has a license office in India has to furnish annual statement within 8 months from the end of the financial year. Why this statement is required? This statement requires so that the tax authorities, the regulatory authorities in India actually can ensure that the activities of license office are limited to what the RBI has permitted. That's communication link. He is not actually doing any business in India. To apply it to non-resident with license office, statement of activities of LO is required. Time limit 8 months from the end of the financial year. 228A. Then we discuss tax recovery. It's two-way provision. Both if there is a tax due to the foreign government, then also CBDT will help the foreign government to recover its dues from the Indian residents or from the non-resident who has a property in India. Similarly, if there is a tax due to the Indian government, then CBDT may request the foreign government with whom the assessee is resident or within whose jurisdiction the assessee has a property. The recovery of tax under DTL. India can recover from foreign country. Foreign country can also recover for India. The CBDT is the channel, is a nodal officer for this. Section 163, representative assessee, agent of non-resident, very important. Indian person treated as an agent, but NR can also be treated as an agent if only in respect of one transaction where he buys a capital asset situated in India from another NR. Business connection or income received, opportunity of being that has to be given. 285A, Vodafone transaction indirect transfer. Indian consent to report foreign share transfer, Form 49D, time limit is 90 days. This is 90 days from the date of transfer, from the date of transaction, if the transfer of share of foreign company result into transfer of management or control of the Indian company as well. Otherwise, 90 days from the end of the financial year in which this transfer of share of foreign company happened. Okay. If it doesn't, Indian company doesn't file Form 49D, then the penalty of 2% of the transaction if there is a transfer of management or control of the Indian company, otherwise 5 lakh. Okay. Now we'll do the revision of entire chapter. Very quickly. So first, in first class, we discussed about the residential status. Here, we discuss the residential status of individual. When an individual qualify as resident. Before this, we also discussed why this residential status is important. Because this is important only for foreign income accruing or arising outside India. If you're a resident, that foreign income is taxable. If you're non-resident, your foreign income is not taxable in India. How you become a resident individual? If you satisfy any one of the basic conditions. If you're here in India for 182 days or more during the previous year, or you stay in India for 60 days or more during the previous year, and 365 days or more during the last 4 previous years. Then there are 3 types of individual to whom a benefit is provided, to whom the second condition, the 60 plus 365 days, is not applicable. Who are they? They are citizen who leaves India for employment outside India, or a citizen who leaves India as a member of crew of Indian ship, or a citizen or person of Indian origin who, being outside India, visits India. But if you are a third category person and your Indian income, including the income from business control from a professional setup in India, exceeds 15 lakh, then if your stay in India is more than 120 days or more, and for last 4 years you are in India for 365 days or more, then you will be treated as resident and RNOR. Okay. Then there's a concept of deemed residency. It has 3 conditions. You must be a citizen, have an Indian income exceeding 15 lakh, and you should not be liable to tax in any other country. There is no condition that you should stay in India. If you satisfy these 3 conditions, then you will qualify as deemed resident. In this case, you will always qualify as RNOR, but deemed residency provision apply only if you are not becoming resident under section 6(1) by fulfilling the basic conditions. Okay. Once you become a resident, we have to see whether you are the individual is a ROR or RNOR. If he satisfy both these conditions, he will be ROR. If he doesn't satisfy even one of the conditions, he will be RNOR. What are these conditions? These conditions are in respect of earlier years. So if he was in resident in at least 2 out of 10 earlier years, and he was in India for 730 days or more during last 7 years. If we satisfy both these conditions, then this R shall be qualified as ROR, otherwise RNOR. Okay. A small benefit provided to a Indian citizen who are member of crew of a ship, which is roaming in international traffic. International traffic means under the eligible voice, meaning it starts from a port in India, has a destination port outside India, or it starts from a port outside India, has a destination port in India. Then if the Indian citizen is joining as a crew member of such ship, then the period starting from the date entered into the CDC as he joining the ship up to the period entered into the CDC as he leaving the ship shall be considered as a period outside India. Okay. So this was the registered status of individual. Then for HUF, if any part of its control and management is in India, then the HUF is resident. If whole of the control management is outside India, then HUF is non-resident. But if HUF qualifies resident, then if the Karta of HUF satisfies the two conditions, that he is a resident in at least 2 out of 10 years and he is in India for 730 days or more within the last 7 years, then the HUF is ROR. If the Karta doesn't satisfy even one of the conditions, then the HUF is RNOR. Then comes the any other person. So any other person means firm, LLP, local authority. They are resident. If any part of their control is in India, they are non-resident. If the whole of the control management is outside India. The concept of ROR or RNOR is there only in respect of individual and HUF. It's not there in respect of other person. Then lastly, we discussed how to compute the residential status of a company. So a company, if there's an Indian company, then it's a resident. If it's not an Indian company, it's a foreign company, then we have to see where it's POEM. If its POEM is in India, then the foreign company is resident. If it's not in India, then it's not resident. Okay. Then we see how we compute the POEM. For the POEM, we first compute whether the company is engaged in active business outside India. How we decide that? There are 4 conditions. If the company fulfills all these 4 conditions, then we say that the company is engaged in active business outside India. What are these 4 conditions? First, the passive income should be not more than 50%, should be 50% or less. The assets in India should be less than 50%. The employees in India should be less than 50%. And payroll expenses on such employees should be less than 50%. Okay. Then the income is computed as per the total income as per the law in which the company is incorporated. Asset means the asset as per the law in which the company is incorporated. Employee includes the employee and also any other person who are actually working as an employee. Payroll expenses include all the expenses in respect of such employee. Passive income is the aggregate of the transaction where the sale and purchase, both the transaction are with associated enterprise, purchase and sale with the AE, and income in the nature of interest, capital gain, dividend, royalty, and rental. But if the company is engaged in the banking business, the interest is not considered. So if the company is engaged in active business outside India, then its POEM is outside India if majority of board meetings are held outside India. But if company is not engaged in active business outside India, then we need to decide 2 things. One, who are the person where the key management and commercial decisions for the business of the entity as a whole are taken. And second, where these decisions are taken. Wherever these decisions are taken is the place where the company has a POEM in India. POEM. Okay, if such place is India, then POEM is in India. If such place is outside India, then POEM is outside India. These reasons, key commercial and management decisions are generally being taken by the board. But if board is not taking their decision, somebody else is taking the decision. It might be the committee, maybe the advisor, maybe the shareholder, or any other person. Then we have to see who is taking that decision and where the decisions are being taken. Simple. We have to actually focus on the substance, not on the form. Okay. The decision which is relevant to decide the POEM is the key management and commercial decision. There are some decisions which are actually being taken by the shareholder, but such decisions are generally about the existence of the company as a whole. They are not key management commercial decisions, and therefore such decisions are not relevant. The key management commercial decisions are relevant. That is whether to enter a jurisdiction or not, at what price a goods to be sold, whether to close a service line, a product line or not. These type of decisions. Once a POEM exists for the first time, then for computing a depreciation, the WDV which was there in the foreign country shall be considered as a WDV for India purpose as well. The brought forward losses in the foreign country shall be treated as a brought forward loss for this year as well, and the 8 years shall start from the year the loss was actually incurred in the foreign country. In such case, if the foreign company becomes resident because of its POEM, then the provision applicable to foreign company shall continue to apply, meaning it shall continue to be taxable as the rate of 35%. The tax of foreign company shall be deducted in section 195. All these things. Now we come to scope of total income. We know for ROR, global income is taxable. R for NR, only Indian income taxable. Indian income means income accrued or received in India, deemed to receive, deemed to accrue in India. For RNOR, a foreign income accruing arising outside India is also taxable, but only if such income is arising from business controlled from a profession set up in India. Okay. Then we discuss section 9, income deemed to accrue arise in India, very important section in the chapter of NR taxation. So first we say business connection. If an NR has a business connection in India, then income attributable to business connection shall be taxable. Okay. Income business connection can exist if you have an agent in India who habitually has an authority to conclude contract and he habitually exercises such contract, or he doesn't have such authority but he plays principal role leading to the conclusion of the contract, or he habitually maintains stock of goods from which the goods are delivered to the persons, or he habitually secures order for you or for another NR who is controlling you or who is under your control, or both of you are under common control. But if the activity of agent are that of an independent one, is acting as a general commissioner of independent status, then his activity will not constitute your business connection. But if he's acting only on behalf of you, of the NR, or the another NR which is controlling you or which is under your control, or both of you under common control, then he will not be deemed as agent of an independent status. Then we said that we saw significant economic presence. Even the virtual transaction can constitute a business connection in India if such transaction has a revenue of more than 2 crore or requires an interaction of user of more than 3 lakh. Then such transaction shall be treated as business connection in India, but the income only attributable to these activities shall be taxable in India. Then these activities of foreign residents shall not constitute a business connection if the activities are confined to purchase of goods in India, collection of views and news in India, or shooting of film in India, or display of uncut diamond by a foreign company engaged in the mining of diamond in a special zone notified by the central government. We have business connection. Then other income which are deemed to accrue or rise in India is income from any property or asset or source of income in India, or income through the transfer of capital as situated in India. Then salary income shall be deemed to accrue or rise in India if services rendered in India. But if you are Indian citizen and you're a government employee, then your services rendered outside India shall also be deemed to accrue or rise in India. But in such case, the allowances and perquisites are exempt. Okay. Dividend. Dividend given by an Indian company is deemed to accrue or arise in India. Is taxable at the 20% in the section 115A. But no expense are allowed, no deduction is allowed. And if the income of the foreign company or the non-resident is only in respect of dividend and the tax is deducted at the 20%, then the foreign company or the non-resident is not required to furnish return of income. This is applicable to entire section 105A. 105A includes 4 types of income: dividend, interest, FTS, royalty. If the income of NR from India is only from these 4 types of income and the payer has deducted tax as per section 115A, then the non-resident is not required to furnish return of income. Interest. Interest is deemed to accrue or rise in India if it is payable by the government or payable by any other person if it is utilized, the money borrowed is utilized in India. Okay. It is taxable in that of non-resident under section 115A at the rate of 20%. But if it's paid by the infrastructure debt fund or 194 LC, LBA, then it's taxable at the rate of 5%. Then we comes to the royalty. So royalty similarly accrue or rise if it is payable by the government or if the right property information in respect of which royalty is payable is utilized in India in a business or funding any income in India. Royalty means transfer of all or any right in respect of patent, model, design, copyright, trademark, secret formula or process, or use of industrial, commercial, scientific equipment, or transfer of all or any right in respect of copyright. Yeah. So, what the royalty means? Transfer of copyright, not the transfer of copyrighted article. Okay. But amendment was made. It's in respect of computer software. It was saying that transfer of all or any right for use of computer software shall be deemed to be royalty. But this is the amendment of the domestic law. If the transaction is covered by the DTAA and the definition of DTAA does not include the transfer of computer software as royalty, then benefit can be availed. Okay. Then we come to the FTS, fee for technical service, deemed to accrue or rise in India if it is payable by the government or if the services are actually utilized in India, in the business profession in India, or for earning any income from any source in India. FTS means Manager Technical Consultancy Services. This royalty and FTS, if they are connected with the PE, then they are taxable under Section 44 DA on net basis. But if they are not connected with the PE or business connection, then they are taxable under Section 155 at the rate of 20%. Then we discuss the presumptive taxation. So there are 6 types of presumptive taxation: shipping, 7.5% of the Indian income. There was Section 172 as well, which defines the complete mechanism of computation, taxation, and collection. Aircraft, 5%, the presumptive income of India. Turnkey power project, 10%. Then there was a non-resident engaged in extraction or prospecting of mineral oil, then also 10%. Then engaged in cruise ship, 20%. And lastly, engaged in setting up, providing facility for setting up electronic manufacturing facility for production of electronic goods. And the presumptive rate is 25%. Where it is 25%. Okay. Then we discuss capital gain. First proviso. So if you're NR and you are investing in the share or debenture of Indian company, then you will get the benefit of exchange fluctuation. The cost of acquisition shall be converted into the foreign currency by applying the average TTBR TTSR rate of the date of purchase, date of acquisition. The sale consideration and transfer expenses shall be converted into foreign currency by applying the average rate on the date of transfer. And the capital gain so computed in the foreign currency shall be recomputed in the INR by applying the TTBR rate on the date of transfer. Then for RDB, rupee denominated bond, any gain arising on account of appreciation of rupee shall be ignored. Then we discuss the Vodafone type transaction, where the shares of foreign company are held to be situated in India if they derive their substantial value from asset in India. While the asset in India should be more than rupees 10 crore. Okay. More than rupee 10 crore. Then we discuss some tax rates. So Section 105AB is applicable on OFO. It's applicable on if the units of mutual fund are purchased in foreign currency. Then interest is taxable at 10%, LTC is taxable at 12.5%. Then 105AD is applicable to FIIs. The interest or dividend income is taxable at 20%. But if you have specified fund situated in IFSC, then the interest and dividend taxable at 10%. And STCG is taxable at 30% and LTCG 12.5%. Then we discuss Section 115AC. Okay, 115BBA, applicable to sports person, sport association, or entertainer who is not a citizen or not a resident in India. The income is taxable at 20%. Then we discuss Section 115AC, applicable to GDR or FCCB, foreign convertible bonds, foreign currency convertible bonds. The interest or dividend income taxable 10% and the LTCG taxable 12.5%. Then we discuss Chapter 12A, which is applicable for NRIs, non-resident Indian. In their case, the investment income from the foreign exchange asset is taxable at 20%, And long-term capital gain is taxable at the 12.5%. But this long-term capital gain shall be exempt if it invested into specified assets within 6 months from the date of the transfer. What are specified assets? Share of Indian company, debenture, deposit, or security of central government. Okay. Then we discuss the TDS provision. Section 195, very important from practical perspective. It says that any amount received by the non-resident which is chargeable to tax in India shall be liable to TDS at the rates in force. Director and directive both can apply to the tax officer to compute the TDS rate. Then there are some specific provision, domestic TDS, which are applicable to NR as well. Section 192 means salary. Salary payable to NR, TDS shall be deducted under Section 192. Then 192A for the PF amount. Then we come 194B, BB, and BA. The lottery, online winning, or the horse races, 30%. 194G, commission on lotteries, sale of lottery tickets. 194N, which is cash withdrawal from the bank, exceeding 1 crore. 194E, which is applicable in respect of income of sportsman, entertainer, or sports association, which was taxable under Section 115 BBA. TDS is 20%. In case of TDS on NR, the base rate is increased by the surcharge and cess. Then 194T, any amount paid to the partner by the firm. Then there are some TDS applicability in respect of interest income. 194LB, which is interest payable by the infrastructure debt fund. 194LC, if interest is payable by the Indian concern if the money was borrowed in foreign currency under loan agreement or by issue of long-term bond or RDB. Okay. Then we discuss about some exemption applicable in the case of non-resident. If he's earning income from his deposited NRE account, then exempt. If the RDB was issued in IFSC for during this period, 17 September 18 to 31st March 19, then the interest on such RDB is exempt. If any deposit made with the scheduled bank in foreign currency, the interest on such deposit, if it's approved by the RBI, then it's exempt. Then salary. Salary of non-resident, though who is not a citizen of India, is exempt if he is an employee of embassy and a similar benefit is provided by the foreign country to our embassy people. If he is an employee of foreign company, but foreign company is not doing any business in India, his stay in India is not exceeding 90 days, and the salary which is being paid to him is not claimed as a deduction against the Indian taxable income. If the employee is a foreign ship and his stay is not exceeding 90 days, but lastly, if he is an employee of foreign government and who is coming into India to give a training to the Indian government employees. In all these four cases, the salary of non-resident is exempt in India. Then there was exemption for IFSC. So there is specified fund which is set up in IFSC. Practically all income is exempt. Not only its income, the income of its unit holders are exempt. Then income from transfer of non-deliverable forward contract (OTC) and offshore derivative instrument is exempt if it's undertaken in the offshore banking unit in IFSC. The amount of lease of aircraft or rent paid by a unit in IFSC is exempt. The income of non-resident account maintained with offshore banking unit in IFSC, the portfolio management service, is exempt. Interest income earned by non-resident from a unit in IFSC is exempt. Where the unit holder of specified fund, the income of such unit holder is exempt. Okay. Then royalty, qua aircraft, or aircraft engine is exempt in the hands of foreign companies. The investment made by Abu Dhabi Investment Entity Authority in India, the investment income and the capital gain both are exempt. Then there is some exemption qua sale of crude oil in India by the foreign company. Okay, this and lastly that today, whatever we discussed today. We discussed today, if you see, we discuss Section 44C, HO expenditure is allowed only up to 5% of the adjusted total income. Then we discuss conversion of foreign branch, the Indian branch of foreign bank into the Indian subsidiary is tax neutral. Then we discuss I hope you can recall all these things. Hai na? We discuss Section 9A, benefit provided to the offshore fund if their fund manager is located in India. They shall not constitute business connection or resident in India. Then we discuss some miscellaneous provisions like 285. The non-resident having a license office required to furnish a annual statement within 8 months. 228A, the foreign government having a tax dues, can get it recovered from Indian government. The Indian government similarly can get its dues recovered with the help of the foreign government. Then with agent of NR, the following person can be an agent of NR. If a person is an employee of the NR, is a trustee of the NR, NR is receipt of any income from him, or he qualifies as a business connection of the NR. Any other person who actually purchase a capital asset situated in India from such NR can also become his agent. In this case, even an NR can become an agent of an NR, but an opportunity of being heard shall be given before making any other person as an agent of the NR. Then Vodafone-like transaction, the Indian company is required to furnish a statement to the Indian tax authority within 90 days. If it doesn't so, there's a penalty of 2%. If there's a transfer of management and control of such Indian company, otherwise penalty of 5%. Okay. So this completes our chapter 21. Do let me know if there's any doubt. I tried that you actually gets the conceptual clarity, because this chapter 21 is in itself a complete practice area where the Big Four is practicing only this chapter 21, the corporate tax division of Big Four. So thank you all for a patient hearing. I hope I have added some value to you. There's, but what's Miss Dhruvi saying? Thank you, sir. Thank you, ma'am. Thank you, everybody. It's my honor that you listen to me. Thanks a lot. Let's conclude the class for today, and we'll meet again. Thank you very much. Thanks. Bye. Good night. And yes, all the best to everybody for your exams.